Welcome to the first UCLA Anderson Forecast Economic Outlook Conference of 2022. 2022 is a significant year for us because this is the 70th anniversary of the UCLA Anderson Forecast. We're the first research center here in what was then the School of Business, now the Anderson School of Management. And it's a big year for us. So pleased to have you all here virtually. We have a small audience. We're working on a hybrid system. We hope to see many, many of you here with us in June. So let me go through a little bit of a few announcements. First of all, we will have some Q&A time. And there's a Slido code that you got if you're inside the paywall. There's a Slido code. And if you don't have Slido, it's a free app. Download it, put the code in, put your questions in there. And that's the way that we will do questions when we get to Q&A. We have a great program today. We're going to start off with the outlook. And of course, it's now a time of huge uncertainty with the war in Ukraine, oil prices going up and so on. And we may not be able to tell you everything that's going to happen, but hopefully we'll give you a guide as to how to interpret events as they unfold and as we give you the forecast. So that'll be delivered by the forecast team. And let me do the introductions. Our first speaker will be Leo Feller. Leo came to us after a PhD at Brown University and time at Johns Hopkins on the faculty and in the consulting world. And Leo leads our US forecast team. Then I will follow, and I guess I didn't introduce myself. I'm Jerry Nicholsberg. I'm the director of the forecast, and I lead the California forecast team. So I'll follow that with the outlook for the US. And then William Yu, who has been with us now a decade, received his PhD at University of Washington and came to us via a teaching stint at Minnesota, is going to talk about a new model that he's developed and as part of ongoing research of the Chinese economy, which is increasingly important for us here in California. After that, we'll have some Q&A. And then we have our keynote. We're focusing, as you know, on supply chains. And our keynote is Jean Seroka, who leads the Port of Los Angeles. And then we have a great panel. And that panel is moderated by our own Ed Leamer. And everyone knows Ed. Ed has been at UCLA for more than half the time of the forecast, I guess. And I was thinking about this morning on the drive in. Ed is my predecessor and mentor as faculty director of the forecast. And between the two of us, we have been directors of the forecast for the last third of its history. Okay, so that's the program. We have some new research, and some of this is in your packet. We have a report on US-China economic relations. So that is sponsored by Cathay Bank. We have a report on commercial real estate in California. That's the Alan Matkins UCLA Anderson Forecast California Commercial Real Estate Survey, and has some really interesting new results about what's going to be happening in office and retail markets. And then coming out soon being in a week's time, is a survey of micro businesses sponsored by GoDaddy. And so look for that. And we have a new Forecast Direct, which is a conversation with Professor Stuart Gabriel on housing and housing in California. And you can find the link to that podcast on our website. So we certainly appreciate the companies that have sponsored this research and the development of new data so we have better insights into the economy. Two other things that are really kind of exciting new initiatives for our 70th year. The first is our Forecast Fellows program. And our Forecast Fellows program is a program to provide a pathway for undergraduate students to move into graduate study. It is in partnership with California State University, Dominguez Hills. Our first two fellows are Bernicia Williams and Christopher Hendricks, and they've just started. They'll be with us for a year. This program is sponsored through the generosity of Edison International, and we're most appreciative of that. And you're going to hear more from Chris and Bernicia, and by the end of the year, they're going to be showing us some new research on important issues in Los Angeles. So this is an exciting new program. And then the second thing is that we now have a board of advisors, and that just started. Our first meeting will be in later this month. And we are really appreciative of all of the executives across the entire spectrum of the economy of Los Angeles and California who have joined us in our board of advisors. They're going to be helping us in the next 70 years in our research, in helping guide our research. And by the way, going back to the fellows, remember those names, Chris and Bernicia, because as we go through the next 70 years, they're going to be here, not me. Okay, so one more thing before we get to what's happening in the economy, and that is our sponsors. You know, we're a public institution, and so we have to live by our budget. And in spite of the governor's State of the Union address, State of the State address yesterday, that the state is flush with money, there are a lot of great things that UCLA is doing. So we're not as flush for money here at the Forecast, and our sponsors allow us to put on programs like this. So I would like to just recognize them. Our principal sponsor today is RSM. Our platinum sponsors, the law firm of Allen Matkins, Cathay Bank, Clark Construction, Leap Development and University Credit Union. At the gold level, Avenue Insights and Analytics, Bank of California, California Bank and Trust, California Steel Industries, Venture Forward by GoDaddy, Pacific Western Bank, Robert Half, United Airlines, and Wells Fargo, the private bank. At the silver level, Hathaway Dinwiddie and Union Bank, the private bank. At the bronze level, Dub Value Creation, HDR, and InstaWork. And at the Bruin level, Gerber Kawasaki Wealth and Investment Management, the Port of Los Angeles, QSC, Rosenthal and Rosenthal, and Webcor. And some of these are new sponsors. We welcome you on board and hope to continue that relationship and really appreciate the support that you have given us. And then finally, our media sponsor today is the Los Angeles Business Journal, and our academic sponsor is UCLA Extension. So lots of announcements, but this is the beginning of an exciting new 70th year for the Forecast, and we welcome all of you. And now let's find out what's going on in the US economy. So let me turn it over to Leo.
Jerry, thanks so much for that introduction. Can all of you hear me okay? The mics are working? All right. So great. I'll be talking about the economic impact of the pandemic, which is finally beginning to wane. But then just as the economic impact of the pandemic is beginning to wane, we're getting the economic impact of the Russia-Ukraine war. And I'll be talking about how this threatens to both increase inflation and slow down the economic growth that we would have experienced but for what's happening right now in the world. So let me start off with big growth numbers. This is real GDP. How is the economy likely to contract as we move forward through the rest of the year? So we grew 5.7% in 2021. This is one of the fastest years of growth we've had since the 1980s. Spectacular rebound in the economy. And then right now, now that the economy, the base effect is essentially pretty high, we've gotten a lot of the easy recovery from the depths of the pandemic. We're forecasting somewhat of a slowdown to 4.3% in 2022, down to 2.8% in 2023, and 2.3% growth in 2024, which is slightly above the previous rate of growth that we had during the past decade. On a quarterly basis, you can see the numbers here for 2022. We did slow down between the end of 2021 and the beginning of 2022 because of Omicron. Labor actually held pretty steady, but we did see the economy take a little bit of a hit in terms of economic activity. And so we're seeing a slowdown from the end of 2021 Q4 of almost 7% growth at an annualized rate, down to 2.3% right now in the first quarter. But then with the Omicron wave easing, we have this 6.1% growth in the second quarter. We expect the second quarter, despite everything that's going on right now in the economy, to actually be a very strong quarter as people return to offices, as people return to consuming services because Omicron has begun to ease. And then thereafter, this is still a very strong year at around 3.5% growth in Q3, 3.1% in Q4. And then in 2023 and 2024, we get to around the normal rates of growth that we've seen prior to the pandemic, which is in the 2.2 to 2.4% range on a quarterly annualized basis. Where does this get us in terms of the level of the economy? So we already surpassed the pre-pandemic peak of real GDP back in the second quarter of 2021. But we'll return to trend by the middle of this year. And so you can see that in this graph, we had this very big shock at the beginning of 2020 with the pandemic. By the middle of 2021, we were back to the pre-pandemic level. But by the middle of 2022, we'll be back at the pre-pandemic trend, right? So our economy has essentially not only fully recovered, but it's gotten back to where it would have been but for the pandemic. That said, despite this very strong recovery, consumers are very pessimistic, right? And more pessimistic than you would think if you just looked at the employment numbers, if you looked at the amount of savings that people have in their bank accounts, the amount of consumption that people are doing. You see here, consumers are as pessimistic, if you ask, based on consumer sentiment, as they were during, more pessimistic than they were during the depths of the pandemic back in April and May of 2020, and just about as pessimistic as they were during periods of the great financial crisis, right? So the economy is doing really well. Consumers just aren't very happy about it. So we should be watchful of what consumers do, not what they say. There's a lot of reasons that consumers aren't happy about the economy right now, right? One of them being that we spent 2 years in a pandemic. And so even though we're doing well, right, there's an emotional toll when we think about consumer sentiment when we spent 2 years in a pandemic. And just as we're coming out of this pandemic, we're seeing higher inflation than we've been used to for the past 40 years. We're seeing a war with Russia and Ukraine. So consumers aren't very happy about what's going on. It's not really a very good time to be a consumer. We're facing shortages on store shelves. We're facing, long, as we're going to be talking about, long delays with supply chains. Products generally aren't available to the extent that consumers have been accustomed to. So it's not a good time to be a consumer, but nonetheless, consumers are still buying at near record levels. They're just not very happy about that. So on the left-hand side, you can see what consumers are buying. We've been buying a lot more durable goods. These are our couches, appliances, cars, right? We've been, we've been trying to buy cars, but we've been facing, shortages in the automotive sector, right? And then we've also been buying more non-durable goods, right? More foods at the supermarket. Where we have been buying a lot less in services. And this is where we're forecasting, a much stronger rebound, which is as Omicron ends, as people return to the office, we end up consuming more services. So all the dry cleaning we didn't do because we were staying at home, right? All the going out to lunch with colleagues because we were working from home and not working from the office. This is where we expect a big rebound. And then also more travel, more going out to sports games, more going out to entertainment as the effects of the pandemic have started to ease. And you can see this again on the right-hand side. One of the reasons that we're facing these supply constraints that we're seeing and the supply chain issues that we're seeing isn't because the supply chains aren't functioning well and moving products, through, from ports in China to ports in the US to distribution centers to store shelves. It's just that we're buying so much more than we've bought previously that our supply chains haven't been able to adjust and keep up. So it's really, a demand story. And you can see this on the right, how much more retail sales and food service we have than we've had, prior to the pandemic, and even prior to, where we would have been given the pre-pandemic trends. So let me talk a little bit about what we're expecting with consumption growth, right? How are consumers going to be behaving going forward? So first, consumption grew almost 8% in 2021, right? We really went out there and bought a lot of stuff in 2021 compared to 2020, right? And then we still see consumption growing. There's going to be a shift from goods to services, but we still see consumption growing overall at about 3% in 2022, 3.2% in 2023, and then coming down to about 2% in 2024. part of the reason that we're buying so much and we can afford to go out and consume so much is that we're back at pre-pandemic unemployment rates, right? So unemployment itself, the unemployment rate has fully recovered, right? We were at 3.8% right before the pandemic hit in the first quarter of 2020. We shot up to 13% on a quarterly basis. It was actually 14.7% in the month of April. And then we've made our way back really rapidly, one of the fastest recoveries in the unemployment rate, back to about 3.9% this quarter. We're currently at 3.8% as of February. And then we're still forecasting that we're going to have a very tight labor market, down to 3.5% unemployment rates, 3.4% by the end of 2024. So a very good labor market in this perspective, that those who want jobs can generally find jobs. And as it turns out, at least among people aged 25 through 54, which is what we call prime age workers, people want jobs, right? The actual employment level, right? What percentage of 25 to 54-year-olds are employed is almost back to where it was right before the pandemic, right? That's the black line that you're seeing on the left. That black line shows the drop in the pure number of workers, right? The share of 25 to 54 that were employed and how quickly it has come back. And you can compare this to previous recessions, to the 1990 recession, the 2000 recession, the 2007 recession. Those recoveries took much longer to get prime age workers back into the labor force. Where we're not seeing as strong of a recovery is people who are not prime age, so people who are above age 55. And that's going to show, we're going to see that on the right-hand side. You can see two lines. The green is prime age workers or prime age labor force, and the blue is workers, is going to be all workers age 16 and up, right? And so you see that the labor force participation has recovered among prime age, but not amongst all workers. And that's because we have this older group of workers who haven't come back into the labor force. They were finally able to retire. Their stock values have been up until recently. Their home prices are still up, and they still have home equity. And so they've been able to retire. And what we had before the pandemic is that many people were working until ages 66, 67, staying in the labor force a little bit longer. A lot of these people have retired. We talked about in a previous presentation how we had about 2 million more retirements than we would have expected during the pandemic. There might be some of these people unretiring and coming back into the labor force as wages have increased, but we really don't expect a big inflow of people who retired during the pandemic back into the labor force, simply because they're okay, right? Especially compared to the great financial crisis. They're okay in terms of their retirement portfolios. They're okay in terms of their home equity. So the need to work isn't quite as there. Let's talk a little bit about wages. So we have definitely seen, given that we've had fewer workers and we've had more labor shortages, we've seen wages increase overall about 5%. But I want to point to you the red line. The red line is leisure and hospitality wages. This is where we saw a huge increase during the pandemic, right? Over 12% increase in wages year over year for this segment, leisure and hospitality workers. Keep in mind that inflation is about 7%, right? So an over 12% increase when inflation is around 7% means a 5% increase in the real wages for leisure and hospitality workers who tend to be at the bottom of the income distribution in terms of their earnings. So workers on the bottom side of the income distribution actually did okay in terms of their real wages, right? Where you don't see workers doing as okay is, in financial activities, where you look at what happened to the real wages that increased below the rate of inflation. That's going to be the little black dashed line that you see there, right? Or workers in the information technology sector, right? That's going to be that little green line. This is where you saw wages go up less than the rate of inflation, right? So those workers are going to be a little bit worse off in real terms. So given that we've had essentially a full employment recovery amongst prime age workers, a full recovery in the unemployment rate, the Fed has met its employment mandate, right? Which is to get a robust labor market, right? Full employment. The focus is now shifting to price stability. So that means that given the 7% inflation that we've had, the Fed needs to start tightening and will likely begin tightening as of March 16th. Chair Powell already announced that they're likely to increase rates by 25 basis points right now in their next meeting. They need to start tightening interest rates to pull back on some of the demand that has been fueling very high inflation. So we're forecasting several interest rate increases in the Fed funds rate throughout 2022. starting with a 1/4 point increase right now in March, getting us to about 1% by the middle of the year, and then getting us to about 1.5% by the middle, by the end of 2023. By the end of 2024, we're forecasting that will be at 2.3% to around 2.5%. So a similar level of Fed tightening as we had, if you look at this graph at that bottom orange line, between 2016 and 2019, right? A slightly shorter time period, but a similar rate of increase from a zero lower bound up to about a 2.5% rate. All right, so some of the other factors that we think might help control inflation, aside from Fed tightening, is higher business investment, right? So right now, businesses are flush with cash, and they've been able to charge higher prices to consumers and pass on higher prices to consumers. And so our expectation is that businesses are going to invest to expand supply, right? If you can sell where demand is still really strong, you build out more facilities so that you can actually sell more goods at this higher price. And so our forecast is that business investment is going to increase about 11% in 2022 relative to 2021, on top of the 7% increase in 2021. This business investment is more oil drilling, more auto production, more supply for the residential construction industry. So more garage doors, more cabinets, everything that we've been supply constrained. Businesses are trying their best right now to actually increase production to be able to take advantage of these high prices. But when you do that, right, when you increase supply, that's going to put downward pressure on prices over the longer term. But, so we've talked about two things that are going to be, helping out the economy. One is higher consumption, higher business investment. On top of this, we have to add in substantially higher government spending on federal defense. So take a look at the left-hand side. This is the amount of government purchases we used to do. And so you can see the green line is what we do in federal defense spending. You can see how much it came down from the 60s and 70s during the Vietnam War, down to about 8% during the Cold War, 8% of GDP, about 6% of GDP during the War on Terror. We're now right around 4% of GDP, right? If we think of ourselves as being in a new Cold War era, this means our defense spending as a percent of GDP is going to start increasing back up over time to around 6% of GDP, right? Maybe 8% of GDP, right? So this is a big unknown. We have to see how events play out, but it would be naive to think that we would stay at 4% of GDP on defense spending given the events that have happened so far this year. So on the right-hand side, we're forecasting this bump up in defense spending. We've been fairly conservative with what that will mean right now. This is a small increase in defense spending. Depending on how events progress, this might be a much bigger increase over time. That will add fuel to economic growth. That will also add some more fuel to inflation, right? If the federal government is also competing for semiconductor chips for airplanes, if they're also competing for steel, if they're also competing for labor, that's going to drive up or create pressure in the labor market and in commodity markets. Okay, so that said, inflation will take a while to come down, right? We're now forecasting it's going to be higher for longer because of the supply shocks related to Russia and Ukraine. I have updated this slide several times over the past week because, when we look at the left-hand side, we can really see, how high inflation has been in terms of both the consumer price index or the personal consumption expenditure index compared to the past, 40 years. The question is, how long will it take for it to decline? And we're forecasting that, yes, there will be some declines over the course of 2022, in part because we're now comparing to base effects from last year that are already high, right? This year we saw in 2021 increasing inflation, but we were also comparing to what was happening, in December of 2020 when we had, massive waves of the winter pandemic, what happened in December of 2020 with, during the holidays of a lot of people getting sick and the economy slowing down. This year, Q4 wasn't quite as bad. And so you're comparing prices during a year when the economy is strongly recovering to a year when the economy was doing pretty poorly. You're going to have a really big difference. But now in 2022, by the time we get to Q4, we're comparing a period where the economy is strong to a period where the economy is strong, right? And so because of that, the year-over-year inflation rate is going to be lower just almost mechanically by the fact that prices were already high in Q4 of 2021. We still have a lot of pressure in here, right? Some things are pulling inflation down. If we're thinking that auto production is going to ramp up, autos were about 2% of all of the inflation, that 7.5% that you're seeing in Q1. About 2 percentage points of that is cars, right? It is used cars, new cars, rental cars, adding about 2 percentage points of inflation. We don't really think car prices are going to continue going up, right? If anything, they're staying flat. We're actually seeing in the Manheim used car index, used cars starting to come down as auto manufacturers have ramped up supply. And so the thought is that there's going to be some factors pulling out from inflation. And at the same time, higher fuel prices are contributing to this. Higher commodity prices are contributing to inflation. Higher rental costs are contributing to inflation. But there's a shift in what's causing inflation. And so because of that, we're still forecasting this gradual slowdown in 2022. We'll still have a 5% average inflation rate in 2022, which is still high, right? But we're getting down to about 4.4% year over year by the end of the year. And then we're really seeing that by the end of 2023 into 2024, we'll be at rates in the 3% to about 2% range, right? Slightly higher than we were pre-pandemic, but getting back to the 2% target that the Fed tries to achieve. So higher inflation for a while, but over the course of the next 3 years, getting back to the levels that we had expected. And it's getting back to the levels we had expected in part because we have the Federal Reserve beginning to tighten, and we have certain factors that are going to be soaking up consumer demand. So one of the factors soaking up consumer demand is higher oil prices, right? This contributes to CPI inflation, but it's inflation due to oil prices, right? If people are spending more money filling up their cars, they're spending less money going out and buying couches and buying refrigerators and consuming services at restaurants, right? So that's going to take out some pressure from that side. Our forecast right now, and again, this is one of the many slides that I've had to redo over the past several days, is that we're going to reach on average right now as we get into Q2, oil prices of $110 per barrel, right? We're above that right now, but this is an average over a period of time. And so we don't think we're going to stay at $130 per barrel. We actually saw gas prices starting to come down. We are expecting that there's going to be a supply response both in the US and potentially in other OPEC countries as Saudi Arabia and perhaps Venezuela are able to start providing more oil into the US. There have been talks with Iran about providing more oil, right? So there's some possibility that there will be several more oil producers to make up for the 10% of global oil that Russia supplies, right? The problem is it just takes time. It takes about 6 months for us to start drilling new wells, getting that to refineries, getting that to gas pumps, right? So for a period of time, we're going to have higher gas prices. For a period of time, we're also going to have higher commodity prices, right? We're focused on gas, but Russia also produces a lot of palladium, a lot of titanium, right? So there's just a lot of commodities that are going to become more expensive, and that's going to feed into the producer price index, which is going to end up feeding into higher prices for consumer goods at the end. That said, let me put one thought into your minds about, is this $6 gas price really all that frightening? And is it going to be such a detrimental shock to the US economy? So this chart is showing you consumer spending on gas and energy in real terms over time, right? Yes, we've reached record nominal gas prices, right? We have, at above $4 on average across the US. We're seeing around $6 here in the US. These are the highest in nominal terms. They are not the highest in real terms. They're definitely not the highest when you think about what we actually go out and spend or what share of our incomes we spend on gas. And the reason is severalfold, right? The price of everything has gone up over the past 40 years, right? So relative to everything else, when you think about it in real terms, right, you have to inflation adjust, those $6 for gasoline. Your wages have also gone up, right? So it's easier for you to afford that $6 gas. Then the other thing that has happened is our cars have become more efficient. Right? Our cars aren't these 12-mile-a-gallon cars that we had in the 1980s. They're, that 40-mile-per-gallon hybrid, right? Or even the 20-mile-per-gallon Ford F-150, right? Our cars themselves are more efficient. So between our cars being more efficient than they were in the 1980s and the fact that you have to inflation adjust that $6 price of oil, here is a chart that shows what we actually spend on gasoline as US consumers. And you can see that in the peak in 1980s, we were spending about 6% of all of our consumption was going to gas and energy, right? We got to below 2% during the pandemic, right? We hit a low during the pandemic. So the change relative to this low that we hit in 2020 is fairly frightening for consumers that had been planning on, spending less than 2% of their budget on gas. Now they're spending, perhaps closer to 3% of their budget on gas. So that is a big change. But historically, we're still at low levels of what we tend to spend as a share of our consumption on gas, right? And so because of that, we really don't think of this as this, enormous supply shock relative to the past 40 years, right? It's a supply shock relative to the past 2 years when gas prices were so low. All right, just to come to a close, there are other factors that we see that's suggesting that a lot of the constraints that we've seen over the past, two years have started to ease. One has to do with auto sales. So here is our look at auto sales. You can see what happened during the pandemic in mid-2021. Auto sales just fell off, and we're at about 13.5 million units a year when they're normally at around 16.5 million units a year. That means that we were 3 million cars short being sold in the US, right? That's what's driving up those car prices, right? And we've already started seeing this, car sales beginning to increase. Our forecast is that this is going to continue. Underlying this is that you can see car production, right? So car production at GM plants, at Ford plants, at Toyota plants has started to ramp back up. And that means that there are more cars becoming available for sale as we progress throughout the year. So it will take through the end of 2022 in our forecast for us to get back to the levels of car sales that we had right before the pandemic. And then for a very small period of time, we will be above the 16 million that we normally sell as people are making up for the cars that they weren't able to buy during the dip that you see in 2021. All right, so just to kind of close out, we still expect higher home price appreciation. There's a huge wave of millennials that are still geriatric millennials like myself, who are still going out and wanting to buy homes, who are aging into their prime home buying years, right? That's fueling very high house prices. If you look at what happened to housing starts, housing construction between 2008 and 2020, really, we were producing so few homes that we just have a supply shortage faced with a demographic bubble of people coming in. Our forecast is still that we're going to have about 1.6 to 1.7 million units of housing construction, making up for some of the supply shortfall, but still not enough given the wave of geriatric millennials and then younger millennials over time who are trying to buy homes, move to suburbs, start families, right? So this is the demographic bubble that's coming up. So, there's still pressure on housing prices. That means we're not likely to see a housing collapse. Housing prices are likely to continue increasing, just not at the same frenzied rate as we saw during the pandemic. So lastly, let me just close by saying that we're in a period of geopolitical and economic turmoil. There's a lot of uncertainty right now. Production and employment have essentially recovered, but inflation, geopolitical conflicts pose an enormous risk to our forecast. So oil prices might actually be much higher than we've been forecasting. Commodity prices might be higher. Inflation and interest rates might be higher. We're likely to get much higher defense spending. It's possible that we'll get lower GDP. There's a lot of people are talking about a risk of 25 to 30% of a recession during the next 12 to 18 months, depending on how these geopolitical events unfold. So this means we're really in an economic boom, but without the euphoria and happiness of an economic boom, just because this is a world filled with so much turmoil that we really hadn't been expecting. And then lastly, we're going to see right now the Fed faces this very tough challenge: how to control the substantial inflation we're seeing, given the supply shocks that we're also seeing, but without sacrificing employment and output. So with that, let me pass this on to Jerry to talk about California. Thank you, Jerry.
Thank you, Leo. Can't really work the mask and drink at the same time. Okay, so turning to California, and George, if you bring up my slides. And here they come. So for California, the theme is really the same as the US. And of course, California is a big part of the US. But there are certain parts of California, certain sectors of California that are larger or deeper than what we see elsewhere in the US. And so that's what we want to focus on here. And I want to start you off with this image of two pictures, because it really illustrates kind of what's going on in the state. And the one on the left-hand side is the front doors to Bradley International Terminal at LAX. And any of you who've been there know that normally is cheek to jowl of people trying to get in and out, and it's empty. And on the right-hand side is a poster from a conference in San Francisco about unicorns, startups that become worth $1 billion, and how they're proliferating in California. And that's really kind of the two Californias. But I want to, well, here's the roadmap. Talk about regional GDP first, and then the sectors that are going to drive the California economy forward, and then a deeper dive into leisure and hospitality. And I'll explain that in a moment, and that'll lead to the forecast. So let's begin with this chart that you just saw from Leo. This is US annual real GDP growth rates. And I want you to focus on two of these. One is this minus 3.4, that's 2020, and then the 5.7, which is 2021. So now, as Leo explained, the US economy is booming. This leads to the question, well, how does California fit into that? Is California a drag on the US economy? Is it leading? What's going on? And so let's look at state GDP. And the first graph that you see here on the left-hand side is 2020. So they're all negatives because I would remember that minus 3.4. And these are the large states, because small states, like Wyoming and Alaska, they're extractive economies. A lot of volatility in GDP growth rates don't make a lot of difference in the US in terms of overall aggregate growth. So these are the large states. California is there in yellow. And because everyone likes to compare us to Florida and Texas, Florida is, of course, in orange and Texas in longhorn brown. And if you look at the contraction here, what you see is that California contracted less than most other states. Washington was the leader all the way over on the left. So we're not starting from a really low base in terms of GDP. Now, if you look at the right-hand graph, that is the first 3 quarters of 2021. That 5.7 that you saw was for all 4 quarters, but state GDP has not been released for the 4th quarter of 2021. And guess where the yellow is? It's all the way over on the left. It's the leading state in terms of the growth of GDP. You see Florida and Texas there, of course. And what I didn't point out is that light blue is the US. So this is all relative to the US. These are the states that are really driving the US economy. And this leads us to 2 questions. One is, what is it about California that's causing it to grow so fast? And the second, kind of an important question is, California has a higher unemployment rate than most of these other states. Why is that? And where is that? And why isn't that pushing that California, that yellow, all the way over to the right of the light blue? So those are the 2 things we want to look at. And the way to get to that is to first look at where is the remaining job loss. So this is by sector, job gain and job loss from pre-pandemic recession, February 2020, to the last month that we have data on, which is December 2021. And if we start on the left-hand side, in gray there is transportation, warehousing, and utilities. That's logistics. And we're going to have a further conversation about that today. But logistics has been a real growth industry in California, a real growth sector. The next one is professional, scientific, and technical services. Now, technology spans most of these sectors in California. So there's no real tech sector, but technology is really concentrated in that sector. So that's a tech sector. And then I've highlighted in green one that's slightly negative, which is construction. And we'll see why that's important. If you go over on the right-hand side, that's where all the job loss is. These are the sectors that require a large amount of human contact in order to deliver the services they're producing. And the big one here is leisure and hospitality. And then we have retail, we have education, and we have other services, and other services is personal care services. So these are low-income sectors, and they represent, in terms of missing jobs, about 80% of the jobs that are missing in California. So when we ask, why is California growing? It's growing because the stuff on the left. On the right, employs a lot of people, a lot of unemployment, but these sectors do not add a lot to GDP growth. Lots of GDP, they're large sectors, but not to growth. They don't grow very fast. So now if we turn and look at what happened in the last 3 months, it's the same chart, but this is September to December. It's not the last 3 months, but the last 3 months of data that we have. And you see leisure and hospitality with the opening up of the economy, we are getting some return of work. And one of the questions we want to ask is that going to continue? Are we going to really recover those jobs sooner or later? Because that impacts our forecast, particularly for employment. The next one is tech again. And then in gray there is logistics, and you see construction in green has now turned to be positive. So let's dig into these sectors. First, tech. From 2019 Q4, fourth quarter, to 2021 fourth quarter, in Silicon Valley, professional, scientific, and technical services employment grew by 15.5%. In San Francisco by 10.6%, Orange County 4.7, San Diego 3.7, Los Angeles is slightly negative, but in Los Angeles, a subsector in scientific research is also in double digits. So this is a real growth sector. It's a high value added sector. It was one of the primary drivers of the expansion after the Great Recession. It looks like it's going to be that again, and that's what we built into our forecast. So turning to logistics, logistics is goods movement. This is air freight. On the left-hand side is LAX and SFO, international air cargo, record levels. And and by the way, that's record levels, even though passenger airplanes to Asia are for the most part not flying. So you've lost that belly cargo space and still we're at record levels. On the right-hand side is domestic air cargo from all the airports in California. The top line there in red is Southern California. The bottom in blue is Northern California. Same thing, goods movement, record levels. In terms of seaports, we see the same thing. There's a peak there. Oh, I should explain the chart. The red is our huge ports in Los Angeles, the port of Los Angeles and the port of San Pedro, and the scale is on the left-hand side. And they're so huge that I had to put the other two lines with the scale on the right-hand side. They're only a fraction of our ports in Southern California. And you notice that even all the way over on the right-hand side where we kind of come off that peak, and that was a peak that you saw in Leah's presentation about consumption, we're still at record levels of goods coming through our ports. The next two, just for reference, are San Francisco Bay ports, primarily Oakland, and the Puget Sound ports. So in logistics, it looks strong, and then with the continued shift to online shopping, logistics is going to continue to be a driving sector. And now let's turn to construction. Home prices in California, well, we all know this, record highs, right? The left-hand side is the Case-Shiller home price index, and it's for San Diego, Los Angeles, and San Francisco relative to 2016, just keeps going up, right? The right-hand side, you see some dip, and you've seen some comment in the papers about that dip of prices going down, but that's just a seasonal. You see the seasonal pattern. This is median home prices from California Association of Realtors. High prices for homes. Homes are selling. That moves construction along, and that gives us our forecast for residential construction, which is a continuation of this trend of increased building. And that is aided by 3 Senate bills that just passed that makes it easier, not easy, but easier to build homes in California, particularly ADUs. So that's one part of it. Let's turn to employment in construction. And what you see are 4 panels here of the 4 types of payroll employees in the construction industry. The upper left is residential, and we just talked about that. That's growing. The upper right is non-residential, and that's been kind of flat. But if you go and read our Alan Matkin's UCLA Anderson Forecast California Commercial Real Estate Survey for winter, which is in your packet, you'll see that we're forecasting a turn in retail and office construction within 18 months. And so the data is supporting that, so that's growing. And then the bottom two, the lower left, is specialty trade contractors, and they support residential and non-residential. So that's going to be growing. And finally, heavy and civil, that's infrastructure. And we have the new infrastructure bill. So all of these say that construction is going to be a growth sector in California. And that's good news because those are good jobs, well-paying jobs, and maybe some of those who are in these lower paying jobs can move into the construction trades. And that leads us to leisure and hospitality and a kind of a deep dive. So I want to illustrate three things here: foreign tourism, domestic tourism, and work from home. So three images there. And the reason why I want to do that is we want to look at where this pain was. You remember we had 80% of the job loss, the missing jobs were in these sectors. So the first piece of data I want to show you is tourism in counties across California. The blue dots, each blue dot represents a county in California. Across the horizontal is tourism expenditures in that county per capita. So we're normalizing because some of our counties are huge, like this one, and some are very small. So that's the horizontal. The vertical axis is the change in leisure and hospitality employment from 2019 Q4. And of course, most of them are negative. But you see this negative correlation that the greater the amount of tourism dollars spent in that county per capita, the less they've recovered. Okay, but all tourism is not alike. We have domestic and foreign tourism. And that's illustrated here. On the left-hand graph, you see international arrivals at LAX, that's the top, and SFO, which is the bottom. And on the vertical axis is relative to pre-pandemic. And they're still 60 to 70% below pre-pandemic. So foreign tourists aren't coming. And just to kind of illustrate that, a Chinese tourist who would come to California goes home, and depending on whether they're going to Beijing or Shanghai or Xi'an, they have to spend 2 weeks to 3 weeks in a hotel room that they pay for, and they can't leave the hotel room. That makes it really costly. So those 1.8 million Chinese tourists that came to California in 2018, they're not coming. So that's foreign tourism. On the right-hand side, and this might surprise you, this is passenger arrivals at Charles M. Schulz Airport, which is in Santa Rosa, wine country. And the first two lines I'd like you to look at are the orange and blue. Blue is 2018, orange is 2019, and you've got a seasonal pattern there. And then look at the gray line. That's 2020, and not surprisingly, it just drops off a cliff, right? Now look at the orange line, and that, I guess it's the yellow line. And that starts out right at the bottom and then starts increasing. In the last 3 months of 2021, record arrivals on a monthly basis at Santa Rosa Airport. Domestic tourists are traveling and foreign tourists are not, okay? And so we want to exploit that and try and learn something about that for our forecast. And the other thing that I want to show you is, again, counties in California. So this is leisure and hospitality jobs per capita. That's across the horizontal axis, and median income. And not surprisingly, higher income counties have more leisure and hospitality jobs. Maybe people eat out more. There are also places where you have job centers and offices. People come into the offices, then they go to restaurants and taverns and shop and retail and so on. If they're working from home, they're not going there. So this is also going to be a factor. So we want to take these into account, and with the realization that international airports are also in these same high income counties, which have these office intensive employment. And we built a model. It's a multivariate model, but I'm only going to show you one of the variables. And the model looks at the recovery in leisure and hospitality jobs as a function of the distance from an international airport, the distance to the county center, right? So counties that are further away have a higher value there. And here is what the model showed us. It showed us that the further away you go, the more leisure and hospitality jobs have come back. And in fact, when you get about 2 hours driving time away from an international airport, there's only about a 5% loss in leisure and hospitality jobs. And what that tells us is work from home is important in terms of recovery. International tourism is important in terms of recovery of those jobs that we're missing. International tourism, we don't expect to come back this year. Work from home, well, Omicron has postponed that. And what that tells us is we're going to have a slow recovery in these jobs. And again, these are low income jobs. These are the folks that have the hardest time making it through, but that actually influences our forecast. But remember that this is not a huge driver of GDP in California. So it slows down our growth in GDP, but still leaves California as a major driver of the US economy. We have tech, logistics, and construction, and those we expect to drive California's economy with faster growth than the US. International tourism and work from home, we just spoke about that. And what we didn't speak about is this defense buildup. That defense buildup will disproportionately affect demand in California for technology and for the building of sophisticated defense durable goods. So that leads to some numbers. Employment, 3.7% growth this year, 2.4%, followed by 1.3%. And that drives the unemployment rate down to near 4%, 4.1% actually in the last quarter. It's above the US. It is usually above the US. Housing, good housing growth, up to 151,000 units per year at the end of the forecast. That is, well, you saw in that graph, that really brings us back up to a higher level than we've seen in a long time. Will it make a difference in housing affordability? No, not really. But it is still a contributor to more housing stock in California and to construction employment. And then real personal income growth, we have minus 2.8 this year. That's a reflection of the end of transfer payments. And then 3.3%, and a little Hollywood Squares box above the other one. So we can't see it, but it is also these are all faster than the US. And so that brings us to the end of the California outlook. So we'll leave you with an image of the Santa Monica Pier. And now we're going to turn it over to William, who's going to talk about the model that he's been working on, the research that he's been doing on the Chinese economy to deepen the forecast knowledge of the Chinese economy and how it's going to affect the US economy. So thank you, William.
Thank you, Jerry. So good morning, everyone. So Jerry talked about California economy. Leo talked about US economy. So today I'm gonna switch gears to talk about China's economy. And now I will, so I will introduce this simple and alternative model for China's GDP growth. So for the detail, you can read our newly released Casey Bank US-China Economy Outlook Annual Report. So this is official China's real GDP growth. So look at it, it's an amazing picture. So before 2010, on average, China has 10% real GDP growth. And between 2010 and 2019, its GDP growth gradually and smoothly slowed down from 10% to 6%. So many have doubt its accuracy of these Chinese statistics. For example, some people say, was China's real GDP really above 9% during the financial crisis? So between 2010 and 2019, was China's GDP economy slowing down less smoothly? And was China's GDP really 2% in 2020 during the pandemic, 8% during the recovery in 2021? So we try to answer this question. So one possible reason behind the doubt of this Chinese statistic is some belief that local Chinese government officials have the political incentive to report high GDP growth, either via government accounting or via encouraging investment without obvious long-term returns. Okay, so right now, let me show you another picture. So in this chart, each dot is a country. So we got 179 countries here. So the horizontal axis is the average of the real GDP growth rates of the country between 2000 and 2020. And the vertical axis is the volatility, the standard deviation of the real GDP growth from one year to the next year for this country during the same period. So you can see on the chart on the top right, usually they are small country, they had a high GDP growth, also high volatility. On the bottom left, usually they are more developed country like the United States. They have low GDP growth and low volatility. And we can see China is on the far right bottom corner. So that means China's economy, based on its statistic, has an impressive high growth and also very low volatility. China is not the only one. We can see that Myanmar, Ethiopia, but those are mostly small countries. And China is the second largest economy in the world. So it's very important for us to understand how accurate the China's GDP growth is. So here we propose an alternative model to measure China's GDP growth. So we use 3 variables which are directly related to economic activity of a country. We assume these 3 variables are more objective, more comparable, and more reliable due to their straightforward collection and measurement. So the first variable is a primary energy consumption growth rate, energy by terawatt hours. The second one is the CO2 emission growth rate. And the third one is nominal merchandise international trade amount growth rate by US dollar, which is the exports and imports combined. So we also try other variables like FDI and credit, but they are not significant predictors, so we don't use it. So we use, what's going on? So we use annual data of the 15 largest economy from 2001 and 2020 to train the model. So we use 2 models here. So sorry about some kind of econometrics jargon here. So the first one is OLS, ordinary least square model without fixed effect. So this is the equation. On the right-hand side is the country's real GDP growth rate. On the left-hand side. On the right-hand side, we got these 3 inputs, 3 predictor, energy, CO2, and trade annual growth rate. So here you can see this yellow color. That is a parameter coefficient of the model. 1.6 means on average for this 15 largest economy, every year, without anything, they had a 1.6% GDP growth. So the 0.4, what does that mean? It means if a country's energy consumption growth increase by 10%, then we predict their GDP growth will have additional 4% growth. And so for the CO2 and trade. And then we also consider about another model, OLS with fixed effect. That is because there's a possibility each country had their unique characteristic to capture the relationship between these 3 inputs and their GDP output. So our model is actually the average of these 2 models. All right, so before we look at the output, let's look at the input. So these are the 3 predictors, what's going on over the past 2 decades. So in this chart, this is the annual primary energy consumption by terawatt hours. So the red line is China, the blue line is the United States, the black line is India, and all the rest of the country are at the bottom. So we can see since 2008, China has become the largest energy consumer in the world, surpassed United States. And now China's energy consumption is 67% larger than the second country, United States. So this is the percentage growth, percentage change of energy consumption since 2001. China is #1, followed by India, Brazil, Korea, and Australia. So this is a predictor too. So the red line again is China. The blue line is United States. The black line is India. So since 2006, China has become the largest CO2 emitter in the world. So right now, China's CO2 emission is 124% higher than the United States. So right now, let me show you, and this is a percentage change of the CO2 emissions since 2001. China is #1, followed by India, Brazil, and South Korea. And this is a predictor #3, international trade. So since 2012, China has become the largest trading country in the world. So right now, China's trading amount is 31% larger than the United States. So this is the percentage change of international trade amount since 2001. Again, China is #1, followed by India. So right now, let's use this input data and then multiply by those coefficients we got from the model. So right now, so let me show you the first estimation. So in this chart, the blue line is the official real GDP growth from our government for the United States. And the red line is our model's estimation. So look at it, it's very, very good, right? So it captures some kind of up and down, capture these two recessions in 2009 and 2020. But think about that. How do we get this government official data from Bureau of Economic Analysis? I believe they collect hundreds, if not thousands, of economic and financial variables and look at it carefully and then come up with this kind of result. But our model only uses these 3 variables. So it's pretty amazing. All right, so right now let's look at China. So again, the blue line is the official data from China and the red line is our model average estimation. So here I show you a little bit detail. So the gray line is that model with fixed effect and the green line is the model without fixed effect. So actually it's in the middle. And we can see basically our model's estimation has been persistently lower than the government official number. So is our model wrong for China? So right now let's look at other countries. So here I show you our model estimation, the red lines for the other major developed advanced economy like Australia, Canada, Germany, France, Japan, Italy. By and large, they look pretty good, right? So you might say, China is not a developed country, so that doesn't work. So here, let me show you our model's prediction on major developing or emerging economy. And for example, Russia, India, Mexico, and Brazil. They are also looking pretty good. Right? So let's go back to China. So if you believe our model is more revealing the reality of Chinese economy, so that means the China's official number has been persistently overstated since 2005. So exactly how much this overstate is over these 2 decades. So don't get me wrong, even like the red line for Chinese economy is still very, very impressive. So here, so this chart is the cumulative difference between the official statistics of the GDP growth and our model estimation between 2001 and 2020. So the bar on the left, which are positive, means the official number is larger than our model's estimation. On the right, when the bar value is negative, it means the official number is smaller than our model's estimation. So we can see China's deviation, accumulated deviation of GDP is 30%. Let's say if you believe our model is true, is better, that means China's economy over the past 2 decades has been overstated by 30%. Okay. So some might argue that maybe our model does not include some kind of unique factor which drive China's GDP growth higher than other countries in our model. That could be true, that's possible. So one example is that our model does not include real estate or housing sector. So let's look at it. So in this chart, I show you the residential real estate investment as a percentage of GDP for United States and China. Blue line is United States, red line is China. So since 1947, so let's look at the United States as an example. We can see by and large, this ratio, this investment share fluctuate around 3% and 6%. And when the United States investment in real estate, residential real estate housing market are approaching 6%, we are in kind of a housing bubble situation. When we are close to 3% or below, we are in housing downturn. And usually they are with the recession. So here, let me quote our colleague Ed Limer, famous insight, housing cycle is a business cycle. So actually, real estate play a very important part for our business cycle. So let's look at China as an example, the red line. So since 2005, China's residential investment has surpassed US bubble level, right? And that's exactly the time, if you remember our estimation, that's the time China's official data are higher than our model's estimation. So let's say, despite China's rapid urbanization, I believe China's real estate investment is dangerous, very dangerously high. So that's why I believe many of us have heard this story about ghost cities in China, like with a lot of empty buildings, tall building, very few people living in there. And the recent downfall of the Evergrande, which is the second largest real estate developer in China, is another vivid example that China's real estate overinvest and overbuild situation. Okay, so right now, let me conclude. So our simple 3-variable macro model can capture GDP growth well for major economies. Our models provides an alternative measurement for China's economic growth. And part of China's impressive economic growth was built on its bubbly real estate sector, which had a short-term boost on its GDP, but will have a negative impacts on China's economy in the long run, because we believe this kind of a high investment will not be sustainable. So anyway, so this research is a work in progress. So we will improve it over time, and eventually we want to build China's economic forecast model and understand how its impact on US and California economies. Thank you very much.
Thank you, William. Do I need this? Yeah, we look forward to China Macro Model 2.0 and the forecast and you know, kind of really fascinating how you get the much lower GDP growth. And there's always been some real suspicion that that was the case. So interesting that you caught it. So I was not looking at my Twitter feed, but rather at your Slido questions while William was talking. And we've got a number of them. We have a little time now for Q&A. And so let me take the first one here, which has to do with the chart that I showed that had the blue dots for the counties. And it asks, what counties are those? That's every county in California. And in that regard, we were talking about leisure and hospitality. And some counties, like Mono County, Mono County is where Mammoth is, and Monterey County and Sonoma County. Those are the ones where most of the leisure and hospitality jobs that were lost have been recovered, especially in Mammoth. But that's every county. And then also some counties, like Colusa, that didn't have much in the way of international tourism or domestic tourism. It was simply people staying home, and now they're going out again. They also are counties where there's a lot of recovery. It's in these coastal cities, San Francisco, San Jose, Los Angeles, Orange County, San Diego. We also have the international airports that we're seeing the missing jobs in leisure and hospitality. So we have another question, which I think, Leo, this is for you. The national forecast seems based on a short days, weeks, Russia-Ukraine war. Have you considered the impact on the forecast? Oh, and Slido there it is. If the war continues over months, maybe over months or years.
Yeah, so I mean, baked into this is the possibility that this is going to go, on for several months. That's already in the forecast, right? There's nothing in the forecast where we think that this is going to end very quickly, which is why we think defense spending is going to go up and stay up, which is why we think oil prices are going to stay higher for longer, why we think that the supply shock related to the war will lead to higher producer prices. So, we are considering that even if the war ends, the economic sanctions remain, right? And I think that's the key point, right? The war might end in a month, it might end in 3 months, it might end in 6 months. But the economic sanctions for Russia aren't going to go away anytime soon. And so that's the piece that stays in the forecast and that actually has longer term effects.
Okay. And for our audience, Ed, do you have a question?
I have a question. Can you hear me? Okay.
I'll repeat the question so that everyone can hear who's virtual. Yes.
Well, I worry that there's a possibility of a stagflation decade going forward because the Fed's ability to control inflation derives from the Phillips curve, which means that they have to create unemployment in order to lower the inflation rate. It's not the small increments, it's that unemployment. When you go back to your image of inflation, in the 60s, there was hardly any. There was a spike up in the early 70s. And what drove it down was unemployment. Then there's another spike up in the later 70s. What drove it down was more unemployment. And then there's a final spike up in the Volcker era, which was driven down again by huge unemployment. That was a period of stagflation created by the Fed's inability to have small increments in interest rates lower inflation.
So let me repeat this for the virtual audience, but not in its entirety because it was sort of a long question, Ed. Ed is really concerned that the Fed's action to increase interest rates is not going to have much, if any, impact on inflation because historically, what's brought inflation down is moving along what's called the Phillips curve. And that means much higher unemployment, and we don't have that. We have exactly the opposite in the forecast. So the question is, will the Fed's move, in fact, bring inflation down, or do we get into a situation with stagflation? Is that a fair summary?
So let me jump in first. There's been evidence over time that the Phillips curve hasn't really applied to recent years, right? If that were true, if the concern about the Phillips curve really applied to the past, several years, we should have seen much higher inflation when unemployment was at 3.5%, 3.6%, below 4%. The Phillips curve basically says as unemployment gets really low, we have a lot of inflationary pressure because of a wage price spiral. As and as unemployment gets high, then that inflationary pressure goes away, right? If you look, and I think, Ed, this is actually something that was in your textbook, right? If you chop the data up from 1960s to now, you'll see that relationship, right? high unemployment, lower inflation, low unemployment, higher inflation. If you just look at the data from the recent 20 years, that relationship goes away, right? And so the Phillips curve, we have to think about, okay, has there been some kind of structural break where this relationship between unemployment and inflation doesn't apply as much today as it did during the 1960s and 1970s? And the data really do suggest that if the Phillips curve still held the way that it did in the 1960s, 1970s, we should have seen higher inflation than we saw in the late 2010s. We should have seen higher inflation in 2016, 2017, 2018, but we didn't get that. There is a concern that the Fed's action, we're talking about increasing rates from 0 to 2.5. That's not that much, right? So, to your point, when you're going from such a low rate to just 2.5, is that going to have that much of an effect in containing inflation? And we don't think that all of the inflation, the drawdown in inflationary pressure is coming from the Fed. It's coming from other elements as well, right? We have to think that gas prices are going to start coming down as supply ramps up, right? That's going to pull inflation down, not only cut back on the rate of inflation, it's going to be a negative pull on inflation, right? As gas prices come down. We have to assume that producer prices come down as commodity production ramps up, right? And so it can't just be the Fed. If we just think that the Fed's actions are going to be responsible for bringing down inflation while we're still experiencing an oil supply shock, a semiconductor shortage, a titanium shock, right? It's going to be very hard for the Fed to accomplish this just with interest rate increases. It really has to be this cumulative effect of greater supply bringing down prices, plus the Fed's action to skim off some of the excess demand that has existed.
So my view is maybe slightly different, but maybe more consistent with your concern, Ed. I don't think this increase in interest rates, if you think we've got an inflation rate that's 7%, interest rates go up to 2%, which they won't this year, that's still a negative real interest rate. So that's not very contractionary, and we don't really have much evidence that interest rate changes at these low levels affects much of anything. And so I think we're in uncharted territory. And the question is, when auto production increases, when oil production increases, when supply chains become more fluid, does that result in prices going down? Or are we in a situation where a wage price spiral starts and we get ongoing inflation and the stagflation that you and some of our other audience are concerned about? And I think we don't know. We don't see in the data now anything that's going to tell us one way or the other. So the way, Ed, that you started your question, that you're concerned about it, I think we all should be concerned about it and really looking at the data as it unfolds to try and figure out what is happening. But we are in a very unique situation with the pandemic, with the supply chains, with the Ukraine war. So a lot of unknowns. We have a question here.
Hi, this is a question for William. Fascinating model. 3 variables, very interesting. 2 questions. Number one, I suppose you're saying that those 3 numbers, energy consumption, CO2 emissions, and trade, are the data are more valid than government released data. And I can see probably trade is accurate, but what about energy consumption and CO2 emission numbers? I mean, you think they're accurate? That's number one. Number two, we know that in China now they're encouraging balanced development and green economy and blah, blah, blah. So does that mean that the officials will have less incentive to overstate growth numbers? And that's number one. Number two, will that bring into question the CO2 emission numbers? Maybe they will want to report lower energy consumption and lower CO2 emissions.
Okay, thank you for these questions. For these 3 predictors I'm using, are they really accurate? So actually the trade data actually is still from China. So the reason I'm using is because the trade is 2 sides, right? If you overstay too much, the other side will the report export, the other side is imports, they will not match. So I'm still using the Chinese data. And for CO2 emission, actually, the data is from these two sources. One is our world in data. This is like a new star. I believe they are doing a very good job, try to collect all kinds of, look at all kinds of source. And the other thing is the latest CO2 information is from this carbon monitor. And one of the contributor for that platform data set is from Tsinghua University. So it's actually the source is from China as well. So yeah, we can always argue, how accurate is the energy consumption will be, but I think because it's very straightforward, it's just real number. The one thing about the GDP number is it is a huge aggregation. So when you are aggregating these kind of things, there's a lot of it, and involving price, involving the inflation, all those kind of things. So it's very difficult to judge, validate its accuracy. But these three variables I'm using is very straightforward. So that's why I'm using that. And in terms of China has been arguing this balanced economy. I think that's great. So for example, right now they are announcing this year, I think it's 2022, the GDP growth estimation, the goal is 5.5%. I thought it's still a little bit too high, but I think that's in the right direction. And what's your another question?
So will that give officials or whoever the incentive to underreport CO2 emissions and energy consumption?
I'm not sure, because I don't know exactly, to be honest with you, I don't know how my source collect those energy. The energy data actually is directly from BP. So I don't know how exactly they collect the information. Maybe they are using satellite or some kind of scientific equipment, which surpass directly the reporting from government official. So I cannot answer you.
So in support of using energy, Li Keqiang, is vice premier of China, said when he was head of the Northeast provinces, that GDP in China was made up, so he uses energy to forecast it. So
actually, let me just chime in. So there are these series of papers called Measuring Growth from Outer Space, where if you can't use energy, you use the intensity of lights as a good proxy for energy. And that you can observe. So the US government has satellites that actually monitor and take regular pictures. And so not only can you see the intensity of lights in different areas, but you can see how they change over time to be able to figure out, okay, well, if we don't trust their energy numbers, we can definitely see, what's going on with the intensity of lights at night to be able to measure growth.
Okay, so we're out of time for questions, but I want to deal with just one technical question here, which is someone commented on the minus 2.6% personal income growth in 2022 in the California forecast. That is negative because the transfer programs, the pandemic relief programs from the federal government and from the state expired. And those transfers are counted as part of personal income. So if you take them out and you just look at personal income as what is generated by economic activity, it goes very much into the positive arena. And you saw that in the GDP numbers, right? So it's kind of an artifact of what personal income is, that we have these transfer payments, but historically we haven't had huge transfer payments like we have had these last 2 years. And so that creates the minus 2.6%. So that brings us to the end of our Q&A for the forecast team. We will have Q&A for our keynote speaker and for our panel. So keep using Slido. We are going to take a short break and then we are going to resume with our keynote. Thank you. So we're really pleased and honored and privileged to have with us today as our keynote speaker, Jean Seroka. Jean is Executive Director of the Port of Los Angeles, which is the busiest container port in North America. And any of you who've been down there, I mean, it's just kind of obvious the massive operation that he directs there. He has been executive director since 2014, and he manages a budget of $939 million, advancing major capital projects, growing trade volumes, promoting innovative and sustainable practices. Gene came to the port after being involved in logistics in Singapore, in Jakarta, in Dubai. So he brought really deep experience to the port and was also nominated or tasked by Mayor Garcetti to really speed the arrival of PPP during the depths of the pandemic. And so it is a real pleasure to welcome Gene to UCLA. Gene, we'll turn it over to you.
Great. Thanks,
Thank
Jerry.
you.
Much appreciated. Good morning, everyone. And thanks for the nice introduction. As Jerry mentioned, I've been at the port now about 8 years. I report directly to Los Angeles Mayor Eric Garcetti, nominated by the city council, nominated by the mayor, approved by the city council. I report on a daily basis to a board of volunteers, 5-member harbor commission. I'm going to have to talk to my media guy. The budget now at the Port of Los Angeles is about 1.7 billion US dollars. So we've nearly doubled it during my tenure through growth of business and other applications beyond the core mission of the port. Today, I'd like to share with you just a couple of stanzas here, and I'm more interested in your feedback. I see Vince Iacopello here, a good friend of ours in the transportation sector. So I'll share a little bit about the economic drivers of this port. There are a lot of numbers. I tend to geek out on this stuff. I like to brag about how important this port is, not only to our great city and state, but our nation. Then we'll talk a little bit about trade that's been in the news almost every day, and myself coming into your living rooms on occasion, and nightly news and cable business news, et cetera, of how we got to where we got in the supply chain, what we're doing about it, and what needs to be done next, and a couple of closing thoughts before I get to the questions and comments. This Port of Los Angeles is now the largest container port in the Western Hemisphere. The first port to cross 10 million container units in a year and 1 million in a calendar month. The work during this pandemic and the subsequent surge of imports, because all of us are buying so much, has been unprecedented, and so has the work on the ground. With the combination of the ports of Long Beach, who is our neighbor, and the Port of Los Angeles, we account for 40% of the United States imports today and 30% of our exports. Ports along the West Coast in general account for 12% of the nation's GDP, and ports across the land account for 21% of that GDP. Some of the numbers that are kind of awe-inspiring for me and allow me to run to work every morning. 1 in 9 jobs in the 5-county Southern California region emanate from this port complex, whether it's dock workers, truck drivers, warehouse people, administrators like me, but more importantly, a wider array of segments in industry. Los Angeles County is still the home to the largest employment base of manufacturing workers in the nation, with nearly 390,000 employees throughout the county working in that particular sector. The cargo that traverses our port reaches each and every one of our nation's 435 congressional districts. This truly is a conversation of national significance. And when such a spotlight has been on the supply chain, from a meeting that I had with the President of the United States on October 13th, to daily work with the White House, the cabinet members, senior officials, this is something that the entire country can rally around when it comes to economic recovery post-COVID-19, jobs creation, and the work that must be done to help support American companies. I think the other area that's extremely important to us and will be as we come up on labor negotiations between our dock workers and employers is that about $300 billion moves through the port in the value of goods on an annual basis. Longshore wage is about $1.5 billion. So the folks who move that cargo are getting a tremendous return on their investment for the skilled worker that's on the ground moving all this freight throughout the country. With all that's been in the news and everyone now observing what supply chains are and how to get goods on the shelves, rising inflation numbers, cargo stuck at ports, et cetera, just take a moment to tell you how we got here in a very nonpartisan way. Back in 2018, under the Trump administration, new trade policy was entered into dialogue. That, along with tariffs on Section 301 and 232 goods, out of a sense of national security protection, were met with retaliatory tariffs in China. And what that did was pretty simple now, with the blessing of hindsight behind us. We saw more imports come in to get ahead of the taxation on American companies, less exports going out because the cost of those products with those retaliatory tariffs became too expensive versus other competing nations. Soybeans are a great example where we have the best quality in the world. We ship just about to all four corners, yet Brazil has been beating us to the punch because they've got a better exchange rate and no tariff barriers to overcome. There are many more stories like that, concluding with the end of the year in 2021 with the widest trade gap in our nation's history at more than 850 billion US dollars, and that gap rose by 27%. The American farmer and manufacturer have been irreparably harmed, and we got to get those folks moving. Flash forward a little bit to the end of 2019, because we hurried in all those imports to get ahead of the taxes, our business fell off a cliff by 16% in the fourth quarter of 19. We had imported all the computer parts, keyboards, brake pads for cars, and other accessories that we possibly could, and our warehouses were extremely full, not just here in Southern California, but across the nation. Then COVID-19 hit the shores of China in January of 2020. The central government in Beijing essentially shut down the economy and the manufacturing center. Our business fell another 19% in the first 5 months of 2020. Effectively, we went 8 consecutive months without importing our normal level of goods, the products that you and I would traditionally buy at big box retailers, home improvement stores, much less parts and components that were going to US factories, and equipment supplies that were going to our medical industry and hospitals. Then the strength of the American consumer took off like we've never seen before in the summer of 2020. We were buying more online. We were going to stores for curbside pickup and inside where they allowed us because we didn't have much else to spend discretionary income on. We weren't flying to see grandma. We weren't going to ball games. We weren't going to the movies. We were spending money. I've got more sneakers in my closet now than I've ever had as a very mature adult because they were on sale and I could buy them. But we also found the convenience of retail, whether it was that curbside pickup or delivery. That was huge for us. And we got into a mode of this is easy, it's convenient, and I can multitask and get many things done while I still have groceries and other products coming to my doorstep. As we continued through the summer of 2020, that cargo just started to go up, and it in effect doubled from when we looked into the abyss back in March of 2020 until the summertime or traditional peak season of 2021. And that cargo continued to climb. In fact, we went 19 consecutive months with volume that was akin to our best peak season month in a calendar year. So we went at peak season volume for 19 consecutive months. Longshore and dock workers were out on the job an average of 6 days a week. Truckers maxed out on their hours of service. We couldn't find enough warehouse workers. Everybody who wanted a job had a job. But there were gaps. Here, even nationwide, we've got almost 10.7 million jobs open as a country. In our sectors of business, we're short a number of truckers. We're short a lot of warehouse people, just to name 2 specific segments that have been harmed through this cycle of attempted economic recovery. And as we've gone into the end, I mentioned on the exports how we've been beaten up because of policy and politics. At the Port of Los Angeles, the nation's largest trade gateway, exports have been down now 35 of the last 39 months. Yet, when you combine all of this, we had the best year ever from a pure volume perspective. It was heavily weighted towards imports, and a newer revelation, empty containers being repositioned back to Asia so they can catch up with the next round of American imports that have become so lucrative to the shipping lines. It used to be not long ago, From Shanghai to Los Angeles, you'd pay about $2,500 for a container. In some spaces, for certain commodities, that could be as much as $20,000 a container right now. But still, in the end, our job is to facilitate jobs creation, economic growth, be good citizens in our community, and establish environmental stewardship like no other port complex in the world. We hit the mark several times, including for the full calendar year. And that volume continues to climb. We had the best January on record. Next Wednesday, I will announce we will have had the best February on record at the Port of Los Angeles. But it is driven by these segments of trade that need to be helped by picking up the exports. And I'll talk more about that in just a moment. Balanced trade will never be the case in containerized business. But if you can shrink that gap between imports and exports, it helps the service providers see more round-trip economics, which makes them more efficient, not just financially, but on the service level too. The velocity of those assets will move a lot quicker. Inverse correlation. As imports have declined over that nearly 3-year period, those empty containers have skyrocketed. Again, many of our imports come from the heartland of the United States, especially in areas of agriculture and manufacturing. Most of our imports go to metropolitan areas because that's where most of us live and most of us buy goods. But to try to triangulate those economics has been a lost equation thus far in trying to help not only economic recovery, but these individual segments get back on their feet as well. I will also tell you this, the phase 1 trade deal that called for $200 billion of additional purchases by China of US exports, largely in the agriculture sector, has been underwhelmingly poor. The China government and their buying sectors have not even touched that incremental $200 billion with a B dollars that was put into the phase 1 trade deal. And we barely creeped above previous year's levels of total imports on their own. The reason for the escalation and the increase in these empty containers going back to Asia, one is that they're getting so much money on the imports, and two, they're cutting the legs off of the exporter. Traditionally, agriculture sector folks who ship internationally here have been known to go after low pricing. They're a backhaul trade. They also ask for 2 wings. One is a storage allotment of time at origin, say 30 days, to load up their product when harvested and they have the ability to shuttle that cargo out. And then for their customer overseas, they ask for another 30 days of free storage so that customer can kind of get a fine tune around how they want to get their product to market. It slows down the velocity of that container, and on average, shipping lines turn these individual container units 8 times a year. If they can get a 9th turn out of that box, that's an incremental 17% revenue, give or take, depending on trade lane and modality, for them to capture, which by far exceeds what they could have gotten just picking up that 1 export box. So we got to find better ways to do this to support American farmers, manufacturers, and companies while not blowing a gasket on everything else that has to be done in the important areas of international trade. So what we started to do to try to improve, and I will level set you with this. We at the Port of Los Angeles are simply defined by state legislation as a landlord port. We have 75 acres of land and 43 miles of waterway that we lease out to private sector concerns that facilitate international transportation of cargo. But you will bet that we are fighting above our weight every day. We're at the confluence of all these activities in international trade. I spent 11 years overseas working in China, Southeast Asia, and the Middle East. I've developed a network of folks in the transportation sector that I'm pretty proud of, but also that can help us in times like this when we've been struggling so immensely. The work that we've done at the C-suite in the private sector with CEOs of these liner shipping companies who are based in Asia and the Middle East is unapproached by any other port complex in our nation, and I would venture to say even farther than that. Direct relationships with CEOs of the Western railroads, trucking firms, the air cargo folks, and everybody in between has really facilitated that dialogue about how we improve. It doesn't hurt when the White House calls you 3 times a week as well to check in and see what you are improving on, where the metrics are, and getting down to business of improving the American economy. We still hold meetings with the White House twice a week. bringing those C-suite of people together from the private sector, federal, state, local officials to help manage the improvements that we've been long sought after. So what we tried to do was really squeeze out the efficiencies of the port. We work about 19 hours a day on average, a day shift and a night shift, all done by the private sector and invested in by that sector, rightly so. On October 13th, the president said that he wanted the Port of Los Angeles to go to a 24/7 operation. His message was this, that we need that largely private sector supply chain to work on a similar calendar as our ports. We're open for business, but we had few takers. In fact, warehouses typically work about 7 to 7 every day. We boast 2 billion square feet of warehousing from the shores of the Pacific out to the desert region of Southern California. No other port complex in the world has that much space under roof. We also have 18,000 truckers that call on the port, but only 9,000 of them call on a regular basis, and we call that at least once a week. The state of California has issued 661,000 commercial driver's licenses for truckers. We're struggling with 9,000 regular callers. We don't have a shortage of workers. We've got a shortage of good jobs in the port drayage arena. These prices have been beaten down by procurement folks at these big box retailers and others to make it non-compensatory for that independent contractor. Private industry has been scared witless for decades that these drivers might organize. With prices now to go 20-mile round trip over $600, maybe it would have been better if they organized some time ago and had some level of certainty in the service that they were delivering and the capacity to move this cargo and be able to scale up and down based on market needs. We've also been working at the federal level on unique opportunities, piloting programs to eliminate using storage fees as weapons against importers and exporters. With ships not being on schedule now for the better part of 2 years, an exporter doesn't know when they must bring their shipment to the port. Imagine if we were going to LAX and we didn't know what time the flight was leaving. We could get there 6 hours ahead, 12, 24, or we could miss the flight because we don't know. That schedule integrity has been missing for some time in the larger business. One of the reasons has been that we've got 10 traditional liner shipping companies that come to our port of LA. Over the last year, 18 new players have entered the market, very few of which had contracts or reservations to call our port before they left Asia with a full complement of containers. They just sped across the Pacific, charging pretty high rates and waiting to see when there'd be an opportunity to pull in and get their work done. No way to run a port business. So there's got to be refinement in that area too. We've designed the nation's first and still only port community information sharing system. Again, think of it. You can order a pizza and track it on an app and know when it's going to get to your apartment or home. Yet we can't track a container. We lose it into black holes. We miss it when it doesn't get on the right train or ship. It's amazing for this industry not to be more savvy with information technology, mainly because people want to hold that data close to their vest. They think it's valuable. They had a 50-year head start on me. Now we've got 95% of all the imports loaded into the system at the Port of LA. We haven't sold a character of data, and we haven't asked for anything proprietary, just generic information. Where are you coming from, where you're going to, who you're using, how quick you need to get there. It's amazing. And we need to make better use of existing capacity. I will share this with you, and this is probably going to be the most shocking series of numbers I give you today. With all the talk of port congestion and ships lined up, all the news helicopters flying over the port looking at these big ships just waiting in the San Pedro Bay, we still, to this moment this morning, have 45% of our truck gates that go used every day. More than half go unused. And 30% of our rail capacity is not being utilized at this moment. Back in the fall of 2021, when everyone's hair was on fire and we had lobbyists running to Washington and Wall Street complaining about ports and saying we're going to miss Christmas and Hanukkah and all the year-end holidays, we were jammed up pretty badly. We had about 89 ships at anchor. We had more than 95,000 containers sitting on our terminal tarmacs, and cargo wasn't moving. It was all gummed up. What we found is that we needed to do a little more collaboration. That's when the White House started calling us 3 times a week. Let's get the business people on the phone. What could we do better? We heard a litany of reasons that we needed to improve and areas that we could improve upon, including trucking and rail and succinct information. We kept going on with diplomacy and collaboration, but nothing moved the needle. We even tried to turn our system from one that's a pull into a push. Simply stated, we put up a calendar, hours of operation, appointment times every day, fill it in, come on over when you can. We turned it into a push system. We know who you are, where your cargo is, how long it's been sitting, and we're going to proactively go to you, line up your trucker, your chassis, everything you need, and we're pushing this cargo out of the port. Because the port is not a warehouse, it's a transit facility. Of the 200,000 customers that call the Port of Los Angeles home every year, we had 20 subscribe to this plan of Accelerate Cargo LA. Things started to click for me. This long old sea salt in the shipping industry, something wasn't working out the right way. We got everybody involved. We went to the White House. We sat with the president in the Roosevelt room. We met with Vice President Harris at a round table with business leaders right in the Eisenhower executive office. I was pinching myself. It was unbelievable, but nothing was moving. And we had major retailers and home improvement CEOs raise their hand. Yes, ma'am, Vice President, we will move this cargo. Nothing moved. GDP stalled in quarter number 3 last year to 2.2% annualized. And everybody was pointing at the port. 60 Minutes came out. Lester Holt came out. Everybody wanted to cover why there were so many issues at the port. So we started doing some data mining. And we were looking at all these containers, all these shipments. And what we found was we had an inordinate number of shipments that were sitting 9 days or longer. And in our business, it's kind of a lifetime. And especially when you're in this type of an economic environment where people are buying so much, you're coming up on the holidays, you're in the middle of fall fashion, you had back to school, Halloween, all these products are supposed to be going to market, much less the medical supplies that needed to get to our hospitals for the Delta variant at the time and what we would then come to know as the Omicron variant. It wasn't adding up. Would you please pick up your cargo? Oh, we're getting everything we can, is what we heard. So we made the gut-wrenching decision on the night of October 22nd, announced it Monday, October 25th, that for any container sitting 9 days or longer, I was going to charge you $100. And it would be compounded daily. If you picked up your container a week late, you would be charged an additional $1,500. That $1,500 was going to go to improvements in the port. It was going to pay some archaic taxation that was done by another private sector group on day side versus night side work for truckers. And we were going to try to use every penny we could to offset the inefficiencies at the port. I went public at our Board of Harbor Commissioners meeting and said, I hoped this was a miserable failure because if we did not collect a nickel, that would mean cargo's moving. And lo and behold, I got threats of litigation. I got dropped off a holiday card list. I'm not invited to parties anymore. But over that period since October 25th, with only the threat of a fine against shipping lines, knowing full well that they would pass it on to BCOs, cargo owners, big and small, family-owned businesses or corporations, that old container segment dropped at its best point by 75%. We scared the daylights out of people. Get your cargo away. We didn't publicly shame anybody. We didn't call them out on the TV or the news. But what we did say was, if you don't need your product, please move it to the side because there are plenty of folks that need this cargo to get to market. We've also reduced the amount of total imports. And as you can see by this slide, about 60% now are the newer imports, which means we've got much more flexibility on the terminal tarmac. Trucks can come in, trains can get built. Think of your grocery store on the weekends. If all the parking spaces are full, and then people start parking in those roadways with the up and down arrows, that's what the port looked like. You couldn't get a truck in, you couldn't get a train out because the system was gummed up. At the same time, people started freaking out because private sector profiteers started opening up parcels of land. There's so much cargo here, we got to let it rest somewhere. If it's not needed in market in Chicago, Memphis, or Dallas, let's just let it rest in Compton or in Carson, one of the close proximity areas to the port, which traditionally has a lot of industrial traffic that goes through residential areas. So these profiteers started opening up hundreds of parcels across the Southland. There would be a day that we'd have to collect those empty containers once they were emptied, shuttle them back to Asia with exports or on their own right for new imports. How do you find all those? Same time, we knew that pushing out a lot of imports would equate to a lot of empty containers that had to be scooped back up. At one point, we hit 90,000 empty containers. Calamity struck again. The phone calls came back to me, and now we're down to about 50,000 as of this morning. Still much more work to do, but some of this effort, again, was around the threat of a fine if people didn't jump into action. And reducing the vessel backlog has met with some media fodder, but basically, back in October, we had 89 vessels sitting outside within eyes view of people who lived in San Pedro, Long Beach, and Wilmington. The industry decided to move a queuing system back to Asia. So once a ship leaves its Asia port of call, last port of call, they could then order or put in their request for longshore labor. Prior to that, they were racing to get to the San Pedro Bay just to put in their tickets for the longshoremen. Don't need to do that. The other thing was with 89 ships sitting right outside our harbor, it was causing an inordinate amount of pollution for our local residents who were just irate. So we had to back those ships up away from where we lived and worked. And lastly, with those ships sitting so tight together, high wind event, think of the Santa Anas, those ships rock in the ocean, putting the crew in jeopardy. So we made some decisions to move that along. We're still categorizing it. We're posting these numbers every day on our hero slide of the webpage, as well as our various social media channels. And this morning, we're at about 50 ships moving across the Pacific. If this were more normal times, it would be about 35 to 40 ships. So we still have a lot of cargo coming in. It's not as backed up as it was. We've increased fluidity at the port, some of it with a little muscle. I still don't like it. My stomach's in knots when you have to have those tough discussions, but it worked. And it just shows that the engagement, trying to see around corners, but equally as important, using data to try to understand where you're at and how you can improve has been fantastic. Much has been said. I'll say one more thing here. Much has been said about the Port of Los Angeles, West Coast ports in general, America ports broadly. They're not as efficient as Asia ports. You can move more containers off a crane or off a machine in Asia, in the Middle East, and in Europe. It's a completely different business model. Here in Los Angeles, we're one of the only ports, along with Long Beach, that welcomes a ship and empties the entire vessel. We then load that vessel back up for its return to Asia. When I worked overseas, same as it is today, many of these ports around the world will empty part of a ship. They'll load part of it back. They have multiple vessel calls at ports all the way around their traditional round trip service. It's about 75 days to go from North China to Europe and back. It's about 35 days running a round trip in the Trans-Pacific. But there are very few ports outside of LA and Long Beach that have the sheer capacity to move cargo, the density of consumers like we do here in Southern California and throughout the country to actually take on a whole ship at a time, load it back so it can return to its origin. The cargo throughput at the Port of Los Angeles over the last 30 days is the best that it's been since we began recording this through our port optimizer. The amount of cargo that moved through the Port of Los Angeles is the best in the history of the Western Hemisphere. Now, nobody's taking a victory lap. Nobody's high-fiving. We've got much more work to do on so many fronts. There's so many stakeholders to deal with, but I really am pleased with the progress we've made today, given that folks go to work every day wondering if they're going to get sick, if there's enough effort going on to get us to the next level of economic recovery, of health and safety recovery. And this example here on the right-hand side of your screen, we've been able to welcome the largest ships in the world, 23,000 container units on multiple occasions. And we hold the world's record for the most work on any one ship on one port call ever, 34,000 container units. So when folks say Angelenos can't do the work, I challenge that. Okay, and this gets to the example. Even through the holidays, we were moving a heck of a lot of cargo off the port into the US economy. We're moving more cargo over the last 30 days than ever before. And where we're going. This dialogue has to keep moving, not just in times of duress. Federal, state, local officials have to remain engaged with private sector folks. Those private sector folks need to work on policy, legislation, and regulation that helps economic growth, enhances our nation's competitiveness, not just when the chips are down. I belong to, I think it's 4 federal committees now on a volunteer basis. That interaction is absolutely effective for me because I'm able to talk to all these decision makers and make sure that those in the elected and policy capacities also hear what's happening in real life. We've got to get a nationwide port community system. Folks in Germany with Dakosi, Singapore with Calista, Nexport in Belgium, just to name three, have been in this business for 3 decades or more. We've got one system that's been in place for 6 years. We got to improve on digital information sharing, much like we have on our electrical grid and in our airline industry. The airlines are pretty good. They compete fiercely every day, yet we still have an app. We know what we're doing. We get to the airport, we see the boards. This industry has got to mature. And we've also called for a national export policy. I don't know what it looks like just yet. It doesn't mean the government has to start writing checks. What it does mean is we've got to upskill and reskill workers. We got to get the American farmer and manufacturer back in the game. Maybe there are ways we can improve those round trip economics by doing more export business. And under Governor Newsom's budget, he outlined $2.3 billion for ports in the state of California. We've got 11 municipal ports today. If that is passed by the legislature, it will be the highest level of budgetary appropriation to ports in our state's history. It also includes a $110 million line item for the nation's first workforce training center, specifically related to goods movement. The port's going to put up about 20 acres of its own land, $40 million of our own money, subject to our board's approval, to kickstart this program. You're going to have a real training site that's going to look like an absolutely professional terminal, but not with all the cargo moving. You don't want apprentices or younger folks or less tenured people operating in this heavy environment with all this cargo moving. They've got to operate in a safe and secure environment so they can learn, get their hours in, get their accreditation, and then go out to a live terminal. That's what this will do. And then lastly, infrastructure, whether it be the Infrastructure Investment and Jobs Act, the pending vote by our legislature on Governor Newsom's budget, we have never been more aligned in a generation between the federal, state, local government, and private sector business on how to improve infrastructure. It's not the answer for tonight. It's not the answer for tomorrow, but it's a long-term investment along with some of the operational recommendations I've made that I think will improve our nation's competitiveness. And then lastly, with this port community system I mentioned, we've rolled out now 5 new modules, all during COVID-19, designed and developed with industry for information sharing. I mentioned we're not in this to profit. If we use information to improve our operations, we get more cargo. More cargo means more jobs, and more of that money coming to the port means more investment back in the port, the community, and our environmental strategy. And the numbers continue to look good. I'll talk just a little bit now about what I see as our outlook this year, and then I'll close there. I know, George, I'm a little bit over time. What we saw during COVID-19 is probably once in a lifetime. For our shipping industry, it's probably once in a decade. When many of us were working from home, some decided that we needed to buy a new couch or a new refrigerator. Some even remodeled kitchens or bathrooms, put a deck out in the back, maybe bought gym equipment. I got back into golf. After 15 years away, I bought new clubs and shoes and clothes. It didn't help my game at all, but the gyms were closed. So I was outside on the golf course hacking away. In other words, everybody spent extraordinarily in different ways that they normally wouldn't. I don't see our imports, our purchasing really dropping off a cliff like we've witnessed in recent years, but it will plateau because you're not going to replace those appliances or those big purchases every single year. But we'll still keep buying. We have $1 trillion in savings here in the US right now, the highest level we've ever had. We'll continue to buy at a certain rate, but we will be going back with our discretionary income to that service sector to various levels, trying to get back out, socialize again, do things with family and friends. I see us with some of the answers on the supply chain congestion improving. I don't think we go back to the calamity that we witnessed back in the 3rd and 4th quarter of last year, but the game's not over yet. We got to continue to improve. We need that national and concerted effort on exports. I'm working directly with the Secretaries of Commerce, Transportation, Agriculture, and Labor in this area. And again, it's about putting together a framework of policy that will entice people either to get back into the export game, hire people that are capable, train folks that are willing. And let's see what we can do to really help out those American companies. On the quarter by quarter outlook, we're going to have a super strong first quarter, buoyed mainly by an early Lunar New Year. So all the work we're seeing down at the port right now is that February 1, Lunar New Year date, the landings are happening now and we're pushing more cargo out than ever. In the second quarter, we're told by major retailers, home improvement stores, they're going to spend that time on replenishing inventory. The inventory sales ratio in the nation is the lowest it's been since 2011. And while most retailers were importing so much product just to keep up with our demand, now they want to get those safety stocks up. You heard CEOs from Walmart and Target on some of the cable news networks say that their inventories have increased at the end of last year, and that's fact. Now the other folks in different segments across retail have got to use that same model, and they will, because that's traditionally our slack or lower season in Q2. If we hit the mark on both of those segments, we're going to pivot into an earlier than normal peak season. Folks, again, will pull forward their inventories for the holiday season. My estimate is they'll start shipping for arrivals latter part of June, early part of July. Normally, that peak season starts in the beginning of September. So these folks are going to try to get a 6, 8, maybe even 10-week run on getting inventory a little bit earlier. Factories have a lot of orders. Shipping lines have only so much space. We've seen what congestion does at ports and railroads. They want to get a head start. Then we'll get into fall fashion, back to school. Even Halloween's a big deal. So if we hit the mark on that, then we cruise into a traditional peak season where we've got to just fly this cargo out to market as fast as we can, get the retailer shelves and fulfillment centers in good shape so we can be prepared to buy starting in October and November once again. Overall, on the volume, I see it as single-digit growth this year, again, for the reasons I mentioned on the extraordinary purchases we saw over the last couple of years, but still good consumer strength. And with any fortune, if we put together some momentum on the export side, those numbers could go up a little bit too. The uncertainties are what we see in the news every day. The atrocities in Ukraine, our thoughts and prayers are with the good people on the ground, but there are complications here with energy distribution, and agricultural products. We'll have to see how the European Union, who relies so heavily on Russia and to an extent on Ukraine's natural resources, can fight through this and what impact it may have in other Western countries, including our own. From here in the Port of Los Angeles, only less than 0.2% of our business is done with Russia. Most of the commercial private sector people have cut them off now. We may see dribs and drabs, but I don't expect too much. And it really is not impactful to our business, jobs, or economy at this point, just as a single trade lane. I know there's a wider view than that. But what we watch for very closely is the threat on the cyberscape. We have the nation's first and only port cybersecurity operations center that was installed in September of 2014. It's now stopping 40 million cyber intrusion attempts a month. That's double what it was before COVID-19. We think it will go higher. Our staff is certified ISO 27001 and higher. These guys and ladies are perpetually trained. They are the best in the business. What we've done is connected with the ISAC in the city of Los Angeles, the NCIC in Washington. The information is being shared on international levels as well. We also have the ability to watch social media chatter and even the dark web to see if there's chatter out there and bad things that could happen that hopefully will step up and stop. All of that effort led us now to implementing one of the world's first cyber resilience centers. This is the FBI's program of Neighborhood Cyberhood Watch, for the first time bringing in the private sector. We now have 44 organizations in the CRC led by the Port of Los Angeles. So as you can imagine, if you see something, say something. If a cyber intrusion attempt happens at company A, we will share that under a cloak of anonymity because we don't want anybody hurt commercially by finger pointing or saying that this guy has a weak cyber platform. But rather, we think the strength of this can be making sure that we understand what's out there. If some of us get hurt, we can wrap that around the entire port complex and its partners and protect many, many others. We've already talked about the infrastructure money. That has to be followed by private sector investment, and I'm pleased on all these levels of supply chain, private sector C-suite, you're starting to see investment follow through off of the IIJA and the proposed budget here in the state of California. People are pumped, they're interested. We've got to keep pushing to the ground. And that, George, sorry, is a little bit longer than you allotted me, but I appreciate the time this morning. Open for a few questions or any kind of comments you all have.
Thank you, Gene. And I mean, that was great and really informative. Over Slido, we have a bunch of questions. And I have
Excellent.
a bunch of questions, but I'm going to wrap them into one,
Sure.
which is a lot of congestion at the ports, still congestion. You're working through it, and is really insightful of how you're working through it.
Mhm.
But there's also discussion about movement of goods through the Panama Canal to East Coast ports to bypass this. And how do you see that as a threat to, how do you see that as a threat to the port, as a kind of long-term threat? And related to that, when do you see the port becoming sort of more normal in throughput, which would avoid that?
Yeah, I was a huge proponent of widening the Panama Canal, developing the third lock, the ability to handle larger ships, because it gives importers and exporters more choice. Here at the Port of Los Angeles, we have been the #1 port in the nation for 22 consecutive years. We don't want to lose a pound of freight. We're extremely competitive. But we also know that since 2002 and the unfortunate labor lockout that we witnessed here, a lot of importers and exporters went to a four-corner strategy, port diversification, not putting all their eggs in one basket here in Southern California. We have lost market share over that time period. We've strengthened in recent years, but there's competition out there. These folks have hired really good people. They've aligned their legislators and policymakers. They put a lot of money in, but here's the problem that I've seen and why we've been so vocal. Over the last decade, the federal government and Congress has outinvested West Coast ports 11-1. $11 billion in federal funding has gone to East and Gulf Coast ports compared to a little more than $1 billion here on the West Coast. That's got to change. We want our fair share. We have to earn it, though. With 40% of the nation's imports, our mayor and I are striving for 40% of those infrastructure dollars. To answer the question of port congestion, again, with 55% of the truck gates open, 30% of the rail capacity available to us right now, I advocate there is no congestion. There are process problems that we have to get to. Importers must pick up their cargo. Truckers must show up on time. We must make the cargo available to those truckers. They're our first and last mile ambassadors. With the cargo ships that are on the way, I mentioned about 50 this morning, if I'm not mistaken. In more normal times, without those new entrants to the trade, you'd see about 30 or 40 vessels on their way from Asia, not in the port just yet. I'd say the coast is not clear, but we're in much better shape than we were even as recently as 3 months ago.
And do we have a question from the audience? Yes, please.
Yeah.
On the municipal ports. I used to live in Seattle. At one point, they had a port. I'm from San Joaquin Valley. They have a port. San Francisco, I think, at one point had some access ways. What are the operations around the rest of the state or even the coast?
Yeah, here in California, we have 11 municipal ports, including the Port of Los Angeles. The bulk of the international trade runs through LA, Long Beach, and to a much smaller extent, the Port of Oakland. San Francisco does a tremendous amount of cruise work and tourism. Wainimi does a lot of, right up in Ventura County, does a lot of work in the automotive market for finished automobiles, and they are the #1 port in the world for bananas. So they're getting all our products to the grocery stores every day. San Diego does a lot of business on vegetation and perishable products, fruit and vegetables, as well as automotive markets. Seattle-Tacoma is the second biggest port complex on the West Coast, run by a great friend of mine, John Wolf. They merged those two ports from an operations perspective, now called the Northwest Seaport Alliance. And those guys and ladies just do a tremendous job. Their main competition are the British Columbia ports, who have been so active in investment. That's why this infrastructure bill is going to be super important to places like the Northwest. But there's a lot of good work happening. Each port, no matter what its size, means so much to its local community. Jobs, the work with education, the work, on research and development, so important. And that's why we've got to keep these California ports running. And I'm so pleased with the response of the governor and Dee Dee Myers and so many others during the height of our congestion. They were on the ground with us, pumping us up, and now they're speaking with their budget. So it's really been good to be a part of. Great question. Thank you.
Thank you.
Okay, so yeah, one last question, please.
Do you see transportation costs coming back down to a more normal level? They're coming through the port for the imports?
I hope so, but it's all supply and demand. There are about 10% of the current capacity on new build orders right now for these ships worldwide. It'd be like buying 10% more buses that we need in Los Angeles, same kind of concept. But those ships won't be delivered until 2023 and 2024. But I'll give you this statistic. A pair of basketball shoes, high tops, that we would normally buy for our kids or our Great Bruin team wears. The transportation cost to get those basketball shoes from Vietnam right here to the campus so the guys can wear them in Pauley, 12 cents. Even if the freight doubles, if it triples, it should not even reach the 7.5% inflation rate that we're talking about on a national basis. So there's some checks and balances we have to have, but freight costs conclusively add to inflation. We got to do our level best to improve service and fluidity. And if there's a proper capacity match with forecasting, why this is so important, I think we see prices normalize, not just on the ocean, but the rail and truck as well. I think this year is going to be a tough one, though, for prices. We won't see easing probably until 2023. Great question. Thank you.
Great. Thank you so much, Gene. Please join me.
Appreciate it. Thanks for the opportunity. Thank you, Jerry.
This was perfect. It sets up the next part of our program with all the questions about supply chains. And this is our panel on supply chains, and it is moderated by Professor Ed Leamer. So Ed, I'm going to turn it over to you.
So do we have the panelists with, are they going to have the mics on, are the panelists? Okay, can you hear me? Am I on? No. Oh, you can hear me? Great. So that was a huge amount of information about the LA ports, but we're going to offer even more because we'll have several panelists in this supply chain panel who are actively involved in the LA ports. And we're under a little bit of a supply chain problem ourselves because one of our speakers has an 11:30 limit and we're pushing it a little bit late. So we're going to have some slight reorganization about how to do it. We'll have 10 minutes from each of the panelists. We're going to start off with Karen Evanoff, who's the VP for Global Supply Chains, QSC. And that's basically electronics of various types being shipped in and out of the LA port. And then the next speaker will Vincent Iacopello, who's the EVP for Growth and Strategy, Albo Wheels Up, which is a freight forwarder. Another lot of information about the LA port. And then we'll do Emily Desai, who's the Deputy Director of International Affairs and Trade at California Governor's Office of Business and Economic Development. And we were going to have her last, but we're going to have her third, so she'll be done by 11:30. And then we'll end up with Chris Tang, who's an exceptional academic and a real studier of supply chains. And after that, we'll have time for Q&A from all of you. So our first speaker we're really happy to have is Karen Evanoff.
Hopefully you can hear me. I don't have the clicker, but I just have a really brief presentation. So I run the supply chain for QSC, which is an audio, video, and control company. And if you look us up, you'll see pictures like this. So we could actually power this room. We could power this campus. In fact, I don't even know if you have any of our equipment, but that thing over there that says JBL is our competition, one of our competition. So we do a lot with electronics, but a lot of other raw materials. Do you have this? Oh, great, thank you. Thank you very much. So, So if you look at our application environment or some of our verticals, we have an entertainment, so live venues, live sound, commercial AV, so you'll find that in like campuses of education, houses of worship, cruise ships in some ways, and then collaborative environments. So this work from home scenario that happened with COVID really amped the requirements on our business. And now people know who we are, the QSys name. I think you have QSC as the live sound, everybody knows if you're a musician who we are. But now QSIS, everyone knows if you're an AVIT who we are, and they're chomping at the bit to get our product. So with that, this little slide you can't see because of that thing, but says pre-COVID, this is what we were facing because we were talking about inflation, right? So I wanted to kind of focus on how it was being impacted. So we had in 2018, we had all this geopolitical stuff going on. I think we heard this morning and just the talk before on all the stuff that happened with trade. So we were hit with tariffs. We buy aluminum, we buy steel, we buy semiconductors, our suppliers buy chemicals. So when you look at that, we had cost increases, significant cost increases, but we didn't pass them on. We just kind of absorbed those. Then we had in our industry a factory fire with a company called AKM that massively impacted the audio industry. And when you think about audio, video, and control, it's in more than just our speakers. It's in every kind of chip that we were buying. We're like, oh my God, here we go. So that ended up, we sucked up everything. We heard it less than 12 hours when it happened. We went out to the market, immediately tried to take in everything we could find before broker grabs happened. And a $3 part ended up being $150. And then it became redesigns and you name it. But we were scrambling and we kept abreast. I have a great team. The team comes from the semiconductor industry, and we just have lots of really good watches out there. I came from the semiconductor industry, and it's a tough market right now, and it's not going to get any easier. Then we had capacity tightening in 2020. Nobody was listening, but wafers shortages were happening. They were saying, oh, we're having a run on 8-inch wafers. And so we're like, okay, let's go see what we need to go suck up there. So we did that. So this was all happening pre-COVID. Now we get into this massive impact with COVID. Demand starts to go down initially, but as we saw in all these other graphs, it started to pick back up. However, I couldn't get things because even through this environment, our audio, video, everybody worked from home, everybody's still wanting to buy things. So our demand on that side did not go down. Live venues definitely went down, but the demand on the other side did not go down. So we're sitting there going, okay, I can't get my stuff out of China. That factory shut down. This factory shut down in Asia. They don't have a workforce coming back. They had another COVID case that shut down. The place in India had a shutdown. Everywhere within our supply chain, it was so globally connected, and all of these markets were shutting down. And then we were faced with all of this container imbalance. This is actually, the green are all the containers. This is actually a picture from yesterday, right, Fred? Yeah. So a picture from yesterday. It doesn't really look much different than before. And this is us trying to manipulate getting everything around. And you'll hear from Vince later, a little bit more on that. But then when you look at this comment, which I really loved from the guy from, I believe he's from Intel, yes. Every aspect of human existence is going online, and every aspect of that is running on semiconductors. So no matter what we were doing, the appetite for semiconductor consumption has grown and continues to grow like I've never seen before. And when you look at all these people announcing fabs coming up, oh, we're going to build here, I'm going to go to Japan, or we're going to build one. I have a friend at Qualcomm who's part of the foundry guy building a whole one down in Texas just for chips that they buy with Samsung. That takes 3 to 4 years. Then they need semiconductors to build the equipment to manufacture it. So good luck. And then we had other catastrophic events like that container right there. We had stuff on that container that had to be offshored in Japan. It took us how many months to get it, Fred? 3 months just to get it off that ship because it had collapsed and they had to find everybody's stuff. And then I think the best thing that you could say came out that there's always a silver lining, or at least I try to look at it, is people now know supply chain and they understand that we need visibility. So the comment that was just made by the previous speaker about, hey, we need to be digitalized. This is so important, more important than anything. And the longer you wait, the further behind you will be in your competition. And this is my passion. And now I think our executive suite has seen the need for that. And I think here's what we're seeing just relative to semiconductor pricing. It is outrageous. Not only is it outrageous because prices are hiking up because they use chemicals that have gone up. This whole bit with Russia and Ukraine, 40 to 50% of the gases that are required to manufacture semiconductors are involved in coming from Russia. the Ukraine. And then the other problem is, capacity will be at an all-time peak, right? So not everybody will be sanctioning them, but those companies in the US that manufacture here, which we do have some, will be impacted by that for sure if they have an alternate source those. And then when we look at just the pricing of brokers, right now, in order to manufacture our product, we have to go to the broker market. So like I said, we have dollar chips going for $50, $3 chips going for $200. It just depends. So all of that now we've consolidated. So our prices didn't go up until probably 6 months ago. We're going through another price increase, and we're talking about another price increase for fiscal year 23. So when you look at that, definitely it's hitting our price book. And yet people are still willing to pay for at least our stuff. I think this is my last slide. I kind of going fast because I know we're behind. And this is just a whole bunch of stuff that I just wanted to show you. All of that, of what we work with our partner, Flex is one of our large contract manufacturing partners. Everything that's hitting us, not only is it a supply shortage, but it's a labor shortage. And when you look at that labor shortage, it's like, where can we find people? I can't even hire supply chain people at a senior level that I want to hire here anywhere. I said, I don't care where you are. If you're located in another part of the globe, another part of the country, I'll hire you. And I still can't find people. So that's going to continue to impact us. And I know we hear about, hey, it's going to come back. People ask me, when's it going to come back? Like I said, if I had a crystal ball, I'd be floating over here on the harbor with my yacht and not working anymore. But I don't see a relief from semiconductors, at least somewhere into the late part of 2023, if we're lucky. So this impacts my business tremendously. I don't see prices going down substantially, and we don't foresee, unless Vince and some of the other guys say more, that prices for freight are going to go down, because our freight, we actually now charge a transit surcharge to them. All of our customers get an increased transit charge. So prices have increased regardless. So we've been impacted. Anyway, that's.
Okay, so that's great. One of the questions that I posed to these panelists was, to what extent, looking backward, did the US growth become less and inflation more because of supply chain issues? And then looking forward, how much of this going to be a problem lingering in the next several years? And you're pretty pessimistic about that.
I am. I'm not a glass half empty person, but I am, just because I know semiconductors and it takes a long time to bring things back up. And I know that the government is fighting for people like Ford, Apple, all those guys get these huge volumes. I just need like a couple of wafers worth, and it's very hard to get. Do I think our growth, if we could have shipped everything we have on order right now, we'd probably hit the way beyond our potential growth market that we were projecting for 2 years out. We'd probably already be there right now. So yes, it's impacted us, and pricing, definitely now inflation has impacted. We tried to hold off for so long because that's just the kind of company we are. We don't like to pass things on if we think it's going to go away. But now even our C-suite has realized it's not going away anytime soon. So I think we're in for the long haul.
Okay, then we'll get our next viewpoint from Vincent Jacopella of the Elbow Wheels Up.
Thank you.
Thank you, guys.
Great job. Good morning, afternoon. Thank you, Edward. So Vince Capella, EVP Growth and Strategy, Alba Wheels Up. As a customs broker and freight forwarder, we have access to myriad of clients that are shipping consumer goods. So we were asked to do a boots on the ground assessment of a lot of the statistics that you've heard today, how that's affecting actual businesses. What a great example just now of challenges and opportunities. We like to say those two words together, but this year felt like a lot of challenges. So let's get into it. I like to start, I don't like to start here, but I think it's worthy to start here, right? Because prior to the pandemic, prior to COVID-19, we had changes in tariff remedy changes in 2018 during the Trump administration. We had the Section 301 duties, otherwise known as the China duties, or some call them the Trump duties, which are now the Biden duties as well. Those were a significant increase on unit price of goods that had nothing to do with demand, had nothing to do with consumer demand. That was strictly what was called a trade remedy or a tariff remedy. There were 4 lists in 2018, 1, 2, 3, 4 for A and B. And by the time we got to the end of 2018, beginning of 2019, it covered billions of dollars in Chinese goods, right? And I mention that because I think we all have to realize that the American importer and the US reseller of goods, whether direct to consumer or to retail, right, bore this cost a year before the pandemic, right? And it did a whole bunch of things. More obvious things like raising the cost of unit price cost per unit from 7.5 to 25% in some cases on top of the regular rate. But it did other things. It caused cash collateralization of import bonds. It had all these unforeseen pressures in the system, right, that weren't immediately obvious. So I say that because I think we have to remember when the pandemic started, people who are manufacturing abroad and selling in the United States direct to consumer or to retailer were already experiencing some trauma. And you could say that, well, it only affected goods of Chinese origin, but Chinese production is such a huge part of consumer, of what is purchased and sold in the United States. So then, the world changed, in 3 weeks, 4 weeks. And, rather than recount chapter and verse of what we all know happened, basically we had a supply shock. The US and EU were open and China was closed. And how do we get we didn't know how serious this was really. We had an idea. And how do we get our goods? And we still have demand for goods. And then the pandemic moves to EU and the US, and now we have demand shock, right? And no one could have foreseen that the PPE, the personal protection equipment market, caused pressure in the air market, and also kept air freight tight. And we didn't see, when we saw ocean freight coming back. And as Gene Seroka alluded to before, we started seeing demand for consumer goods go up towards the end of the summer in 2020, right? Which was kind of a surprise. We all thought everybody was home, but it wasn't a surprise if you walked out my own front steps and I trip over the box that's on my own front steps, and my neighbors all have boxes up on my whole block. So it wasn't that much of a surprise. So a couple of things happened, which are obvious, right? Nobody was going to stores, but consumer buying habits had changed to direct to consumer. And we saw this explosion in direct to consumer in logistics. And another thing happened. Customers were calling us saying, you know what? We have to actually design the value of the product. So people were changing designs and changing marketing because the product has to be delivered to a door now. So it actually, how that product was delivered became part of the product. It actually became part of the value of the product. It wasn't just an afterthought. How am I going to get it to market? So during the pandemic, we saw this tremendous shift. We should mention that in 2016, I'll try to speed this up. In 2016, the Trade Facilitation and Trade Enforcement Act was passed, raising the de minimis amount for direct-to-consumer imports from $200 per consumer per day to $800. That was seemingly benign in 2016. But when you add it to the change in consumer buying habits, it exploded direct-to-consumer. Because now it was easy to get goods into the country up to $800 per consumer per day duty-free. So it absolutely accelerated direct-to-consumer. So now we fast forward to 2020 and 2021, and like many speakers already talked about, we had a July and August of 21, which was the worst port congestion ever experienced in, I think, global trade recorded modern statistics. And a couple of things, just like in finance or in banking or in governments, whatever was weak in the system prior to the pandemic got worse, right? So we had a dress rehearsal for 2021 back in 2010 at the end of the first recession, the big recession, when we had congestion issues in 2010, and we had a similar situation, not nearly as bad, in 2017. So I think Gene Seroka did a great job of addressing those issues. But there are certain things we knew going into the pandemic.
You're gonna wait about 2 more minutes.
Sure. Certain things we knew going into the pandemic. We knew that we needed to leverage technology, advanced data, which we had not done sufficiently. We needed ocean carrier policy, which is decisions that ocean carriers make, to be more mindful of demurrage and detention charges, which were one of the largest unbudgeted expenses that were borne by producers and resellers to retailers. We needed better equipment management. We needed better labor management, right? We needed to be 24/7. Gene mentioned all of those things. So we knew all those things, but all those things exacerbated the pressure that we were feeling back then. As already alluded to, we saw quadrupling of freight rates, month-long delays. This we thought was going to be an inflation fuel. We saw, I'm not going to mention numbers, but 4 or 5 times unbudgeted freight costs on top of these duties, the Section 301 duties, on top of demurrage and detention. Our company paid out millions of dollars in unbudgeted demurrage and detention on behalf of our customers. Not all of this was able to be recouped by retailers. If your purchase order was 90 days old and you didn't have it in the purchase order, basically at the mercy of the retailer, you negotiate the deal. If you're going direct to consumer, you could maybe raise the price to the consumer, but many companies really, I'm gonna wrap it up here. Many companies actually just had it eat into margin. So what we noticed in August of 21, many companies changed strategies, and we believe it was successful. Their margin in 21 was devastated because of the unbudgeted demurrage and detention, the quadrupling or quintupling of freight costs. And you have to remember that truck cost, rail cost, warehousing cost increased by the same rate across the board at the same time that ocean did, right? So all unbudgeted, not all of it transferable. And so basically customers made a decision that whoever had inventory in August of 21 or September of 21 won, and that they would try to recoup margin in 22. And they had to show the retailers that they could deliver, that they had goods, and if they had margin loss in 21, they had to bear it, and many of them did. And the strategy was to make it up in 22. So I'm not going to predict what happens. I will tell you, I'll finish with this. There are 2 camps in international trade. One says that consumer demand and capacity on ocean freight, demands for ocean freight capacity will soften this year. And another camp says that it's going to go all the way to 23. Both agree on one thing. It's consumer demands for goods that are driving the demands for capacity, shipping capacity. So until consumer demands for goods softens, you really don't see a drop you don't see a demand drop for capacity. Is that softening of demand inflation? I don't know, but until demand softens, that's it. Here's the silver lining. I want to reference, I'll finish with this. The silver lining is that all those pain points we mentioned, and Gene Seroka is exactly right. There's been a multi-stakeholder kind of consensus that we must solve these 5 or 6 pressure points in the supply chain, including mostly advancing technology and the use of advanced data to forecast. It's not a choice anymore. There seems to be a galvanizing effect that the stakeholders have come to the realization that we have to solve these problems. So out of this crisis, we hope to build stronger infrastructure, and we hope to leverage technology better. So.
Okay, thanks very much. We have to move quickly on to the governor's office with Emily Desai.
Yes, thank you. Hi, everyone. It's great to be here. Thanks very much for having me. I don't think you could have more esteemed speakers than the economists at the Anderson School on inflation dynamics or the broader, context the port impacts from Mr. Seroka. So it's a real pleasure to be here. And of course, the on-the-ground perspective of actual exporters and freight forwarders like my fellow panelists. So that perspective is fundamental. What I thought I might do is just quickly focus my comments a bit on the thread on inflationary pressures, a bit about the port impacts, but really focus on what we're doing about it. So we've talked, I think now quite a bit about the challenge of keeping pace with, demand change that is staggering when you think about it, where exposure to foreign bottlenecks, with the globalized supply chain has played that very significant role in spreading the effects of supply chain disruptions to the price of goods. So although labor shortages have kept pace to some extent, what we're seeing is that we know wages have gone up at a slower pace than prices. And so I think it's important to center that in this conversation too. I checked this morning, a 10-year Treasury note is yielding about 1.8%. So I think we can imagine what this inflation means for the millions of people who have their current or future money in pension funds, in Social Security trust funds, et cetera. So we need to be mindful, of what that inflationary pressure means for the average Californian, for the average American. So what are we doing about this, right? What are we doing about these broader supply chain impacts, about port congestion? Mr. Seroka obviously laid that out just beautifully. And it's an incredibly complex issue that really requires a whole of government approach. Ed, you had asked me a question about sort of the public-private partnership here, and I think it's absolutely fundamental that we approach on all sides with answers and solutions to this problem, which we know have been years in the making. There's been significant progress, I think, to address some of the disruptive effects of the pandemic. Obviously, many challenges remain. We're looking long-term at all of this. We hear a lot about this term supply chain resilience. The Department of Transportation at the federal level refers to that as building a system that can respond to changing conditions, a system that can withstand and rapidly recover from disruption. And we know that the pandemic is going to continue to create that disruption, but we also know there's more to come. Supply chain is going to be impacted by climate change, by many other things. So building out that resiliency over the long term is critical. So with significant federal engagement and really built upon that public-private model, California is leading the way here. Mr. Seroka pointed out, the governor's leadership on this and the work of my boss, the head of GoBiz, and the governor's senior economic advisor, Dee Myers. I want to point out a few examples that really underscore what California is doing here. Some of you may know that Governor Newsom signed an executive order back in October directing state agencies to look at additional ways to alleviate congestion at California ports. That executive order asks agencies to continue our coordination with the Biden-Harris administration, the supply chain task force that they created to work with states, to work with the federal government to address these global challenges. The governor's executive order also asked us to work with the Department of Finance and with other agencies to develop those longer-term solutions. We've worked to identify state-owned properties and locations that would be available to address short-term storage needs, identify priority freight routes to be considered for temporary exemptions, for gross vehicle weight limits, opportunities to really expand workforce training and education programs. And that's really, seeing results. We announced in mid-February that 6 of those California sites were identified. Leases have been signed to create space for storing shipping containers on state property to help alleviate some of that congestion. We've announced a strategic partnership between the California State Transportation Agency and the U.S. Department of Transportation for up to $5 billion in loan financing to really look at the portfolio of freight and good movement and supply chain resiliency projects. We've issued temporary permits for truckers to carry increased loads. We've looked at things like, working with our DMV to increase the capacity of commercial driving tests to address worker shortages. And then, of course, there's been a lot, said rightfully about the impact for California farmers and our agricultural community, given some of the export dynamics, again, that former speakers have really pointed to. So we've secured a 22-acre pop-up site in partnership with our friends at the California Department of Food and Agriculture and the USDA, located at the Port of Oakland, to assist agricultural exporters in storing their products and getting them overseas and getting them onto containers. And this is just now becoming operational. So there's movement being made here. Mr. Seroka also pointed to what is an absolutely historic investment in the governor's budget for investments in supply chain and port infrastructure investment, which is going to really continue to move the needle. So one other area that I wanted to point out, in addition to these incredible and historic investments, that the governor is making and that we are doing hand in hand with our federal partners, is also making sure that we keep an eye toward the effects and the impacts on our small business community. My team works with the Small Business Administration on a grant called the State Export Promotion Program. We provide direct grants to our small business community to help them export. We're looking at doing more export training to help our small businesses see trade as part of their economic resiliency and recovery strategy. So I would also point out that it's critical we keep an eye toward what our small businesses need. We know that, over 60,000 of California's 4.2 million small businesses export here in California. We want to see that number grow. We want to see our small businesses enter global markets. And so that's another sort of fundamental piece to this puzzle here. But I'll stop there, in terms of overall impacts and what the state is doing. And again, just appreciate this opportunity and all of the great work and information shared by the panelists today. Thank you.
Okay, thank you very much. I just add a little footnote to what you said, which is the COVID-19 has revealed that the private sector in the medical area is incapable of preparing for the pandemic. And the same thing is true with the just-in-time supply chains, just-in-time inventories. They work when you have predictable, smooth demand. But when you have these extreme swings, they're not going to work well. The private sector isn't going to be able to prepare for the extreme swings. We've heard from Emily how they're trying to correct the situation today. But a question is whether going forward, the federal and the California government has to intervene and change the way these supply chains are organized. In the same way, they should make sure that medical devices and PPE are available in the event that there's another pandemic. With that thought, then I'm going to move on to Chris Tang, who's going to wrap this up with all the insights that an academic offers. And I hope Chris Tang is going to show up here.
Yes, Ed, thank you very much for having me, and hello, everybody. I think that as the last speaker is always very dangerous because you do not know what the other people have to say. Then the question is what's left to be said. So I think that Jean Seroka and other panelists, they have really talked about in terms of the infrastructure need, which is for sure, and also in terms of information technology support. And also on top of that, also in terms of automation. So I think that in the long run, we need to do all that. There's no excuse. Now, but I think that in the short term, I think we need to settle the following statements. United States is going to continue to rely on China imports. There is no other alternative. Let me use a couple of examples. First, face masks. Due to COVID, we have a shortage of face masks, and the United States trying to produce some of the N95 face masks domestically in the United States. Very good. 29 companies started out. The demand went up and it went down, just like the Omicron. So in the case, they cannot really sustain that kind of operations domestically. So that's why right now they still rely on the import of N95 masks from China. So although that we had the trade war with China, the imports volume did not go down. The trade deficits with China continue to go up. So that is the short term. Now, in the long term, I think that Ed pointed out rightly, then how do we develop a resilient and I call it sustainable supply chain within the region? Now, that means that we require additional thinking. Right now, it's gratifying to see that the government is providing funding to improve the port operations, and also the California governor is also trying to find warehouse space to really soothe the current crisis along the port. But in the long run, we need to rethink what kind of supply chain we're going to build. President Biden actually commissioned a task force to look into 4 different sectors: semiconductor, electric vehicle, rare minerals, and also pharmaceutical product. These are all good. Now, But I think that the consumers and also the governments focusing on the end product, but that is very dangerous. Let me take semiconductor, for instance. Right now, we are expanding the capacity in the United States to make more chips. We have Intel is building up more plants in Ohio and Arizona, and so is Global Foundries. This is a good thing. But building the wafer fabrication facility will not solve the problem. Why? Because we really need to look at the entire supply chain, not just the end production process. As it turns out, I read an article about the shortage of semiconductors. It's not just about the wafer fabrication facilities. There is a shortage of silicon wafers, and in particular, the substrate. The substrate is actually the bottleneck. So we need to understand you cannot just move one of the operations of the supply chain back to the United States and hope we'll solve the problem. In particular, we need to move to build a smaller scale of ecosystem, not supply chain, it's supply ecosystem, such that we can produce self-sufficient in a smaller scale within the region, just in case there are some geopolitical issues that may arise. That's what we're seeing now. So in the case, I think that we need to pivot our thinking, not just for a particular operations or supply chain, but the entire ecosystem. That's semiconductor. PPE, same issues. The face mask shortages is not because of the capability sewing the mask, it's a simple operations. What was lacking was the melt-blown material, the material used in the middle layer. And I think that we need to have this kind of capability in terms of research and development capability that pivot into new technology. So we should view this crisis as an opportunity for the United States to build new research and development capability, which requires the cooperations and coordination between the government and the university and the private sector. By doing that, that will rebuild the golden era, such like the internet, and or maybe the mission to Mars, such that the United States regain some of the capability. Right now, we lack the capability. So that will take a long time. But I think the government can play a critical role, not just focusing on short-term fixes. The short-term fixes would not solve the long-term problem. So I think that is something we need to think about. Now, there is labor shortages, as earliest panelists talked about. We have people, but we don't have the people with the right skill for the right process. So therefore, I think that there would be needed a really coordinated plan. Maybe you call it industrial policy, maybe different policies, such that the nation can create the right type of skilled workers for the jobs for the future. So that also require a really coordinated plan between the governments as well as a university, as well as the private sector. Maybe some form of a new type of education program, like the apprentice program that we used to have. So that is something we need to rethink about the entire ecosystem for the supply chain, such that they will be more secure. Now, that is on the long term. Now, in the short term, there are crises. The conflict in the Ukraine actually create another food shortage problem. So the inflation is not going to go away within a short period of time. Now, here is an opportunity for the United States. United States is strong on agricultural products. Right now, Russia actually is a major exporter of fertilizer, in addition to other basic materials. The fertilizers, the ban of exporting the fertilizer will reduce the yield of the crop production for the world. Then if the reduction in crop production in the world, it will reduce the animal feed, reduce the amount of food for humans. So as a result, it's actually will also reduce the food supply for the world. Now, United States can help out. United States is one of the biggest exporter of fertilizers, as well as wheat, as well as other products. So right now, we've been focusing on the import And actually, there is a good opportunity for export as well. So I think that we should also think about not just the inbound of the supply chain, we also need to start thinking about the outbound the supply chain. So that will also reduce the trade deficit. So I think that that is a golden opportunity to rethink how the United States can engage with the world, how we can improve and increase the export of many materials. I'm going to stop here so that Ed can start the Q&A. Thank you.
Thank you very much. That was great. I wonder if Karen or Vince have any reaction to what we just heard about treatment of the long-term supply chain issues.
This is Karen. I totally do. I really loved what he said because his comment on semiconductors and building an ecosystem, I think if we want to become resilient and sustainable, we can't rely 100%. Are we ever going to get back to being the US that we used to be in my dad's day? Probably not. But I do believe that there are ways we can build ecosystems, even if it's partnering with people like Mexico in some areas. I think the food shortage thing is something that, because I have friends in the Ukraine right now, is something that I'm really close to because I hear it with my friends, even in Italy. Prices were going up a long time over there. Now they're going up substantially. So how do we get people to communicate and to work together? I feel like this world we live in becomes less and less unified, all because of monetary things or political things. And I think we have to get over that and look to see how we can help. But it's hard to do because of those blockages, but it could be very easy to do if we all got together. So I 100% agree with you, Chris. I loved hearing that. It was perfect.
But it does seem to me that the private sector isn't going to make these changes. It has to be induced in some way by the governments
I
around the
agree.
world.
Unless there's money in it, it's the what's in it for me.
Yeah.
Yeah, I agree with Karen with her statements, and Chris said something that I say often. Spending 32 years in LA managing Chinese products coming into the United States, Chris said it's very hard to replace Chinese production capacity, right? And the only country at the beginning of I'll go back to the 301 duty discussion, the only country that our customers saw had the labor force, they did not have the infrastructure, unfortunately, that could maybe give China a run for their money would have been India, right? But it didn't work. It didn't work in 2018. It didn't work in 2019. So I think Chris said something very brave, which is not very popular all the time, that really, if you look at production capacity in Central America on garments, if you look at light assembly that's moving to Mexico to move out of China, it's assembly, it's still being manufactured in China and assembled in Mexico. So it's very difficult to find production and manufacturing capacity that is good quality on time to the volumes that are coming out of China right now. And I think that's a true statement, and it's a reality that I think we just have to be aware of.
But when I think about China, how did China get there? I mean, I was again, I'm very old. Keeping that in mind, guys, for you young people out there. I was part of the wave of people in the early 90s that started moving, even late 80s, started moving things to China. Right. And when you look at the semiconductor industry, I was partnered with half these companies that were like, yeah, we can't afford to build these fabs by ourselves with all this new technology. I mean, you just look at silicon germanium. There's only a few people in the world that do that. IBM, one of them, was the leader. And then you would work with people like China and TSMC specifically too. And I won't go into that political issue, but we went over there as teams of people and we helped develop. So then it's like, all right, now we trust them and we're just going to give them everything. And I love the people I work with in China, but then the politics gets involved. So if we are willing to be that open years ago, there's no reason why we can't be that open with other countries friendlier, maybe to the US. Or, think about, to Chris's point, training. Right. I know a lot of schools do supply chain, but when you hire those people out of the school, they should have more experience coming out of school being either interns. We should be willing to intern and train them while they're going to school. And they should get credits for that. So they don't have to worry about, oh, how am I going to pay for this or that? And they come out having real life experience, because I've had some of the best trainers, but they've all retired now. How do we get that same skill set?
But the huge trucker turnover that occurs is because the job is so onerous and
Yes.
doesn't pay enough to offset that.
Pay more.
Pay more, yeah.
But like I told this gal, she was in home goods. Okay. I'm also a supply chain person. I don't like to spend a lot. So I sat there and she's sitting there. I'm just looking at a container to put cereal in. And she's like, well, we got to her friend. Well, we've got to, make sure this isn't in China. And I literally stood there. I turned her and I went, ma'am, you're in the wrong place if you think that this stuff isn't made in China. If you want a low cost, that's why it's made in China. And she goes, well, I go, so if you're going to say that, put your money where your mouth is and pay more. So I think that's part of our problem. You're right. If it's not in the money.
Well, I would add, it's also the deficit, the huge external deficit where we import a whole lot more than we export. And from the economist standpoint, that's created because we don't save enough as a country. Right? We have investment opportunities. The foreigners are going to take advantage of these investment opportunities because we don't fund them ourselves.
Yep.
That creates a deficit. So the federal government, the huge federal government deficit is a way of amplifying or increasing that external deficit. That's like $600-700 billion. If we had more of that being produced in the United States, we'd all be better off.
We would be. Yeah. Creates jobs.
Do we have questions from the students or?
Well, I have a question.
Okay.
So when we think, thank you. So when we think about supply chains, there really isn't just one supply chain, and I'm wondering what you all think about the differences, and should we be thinking about these differently? For example, there are raw material supply chains, and we're thinking a lot about that with the Ukraine war today. So that's raw materials to manufacturers. There's business to business, which is components. And you think about that with aircraft, that components are made all over the world. And then there's, Vince, what you were talking about in part of your presentation, direct to consumer. So those are three different kinds of supply chains. Should we be thinking about those differently? Or when we're talking about supply chains, are they all the same? So I'm interested in what all the panelists have to say.
Because the direct to consumer model, you can bring it in to an old model and pay duty and still deliver it to consumer. But you don't have to pay duty, right? So now your consumer or your retailer can dictate how you cross the border, whether you pay duty or not, right? So you really have to start with the end in mind, right? You have to start your process with the end in mind. What's really interesting is that there are these huge warehouses at Otay Mesa, which is the San Diego border crossing. I think, I don't know if it was the LA Times or one of the San Diego papers, had this revelation that they were all filled with Chinese goods, that none of them were Mexican or US goods. And those of us in supply chain have known that one of the things the pandemic caused, and Karen knows this, right, is that when you're having a sourcing discussion, which 25 years ago, I'm older too, 25 years ago was a simpler discussion, right, about sourcing. Do I do it in Vietnam? Do I do it in Honduras? Do I have t-shirts, or do I do it in China, right? It was a simple discussion, is now very complicated, because now do I move raw material or do I move semi-finished material? Do I assemble it in North America so I can be closer to the consumer? I'm nearshoring. I'm not stuck on a boat outside Long Beach for 5 weeks, right? It's in this market, closer to this market. So all of these considerations, some of them are proactive, some of them are reactions to the congestion, but Karen, I'm interested.
Yeah, I mean, I think it's a yes and a no. It depends on where you play in the field. But for me, just always being a manufacturer of some sort and always looking at the raw, and now, when you're looking at compliance is a huge thing, whether it be regulatory or material compliance and where you're selling it. So all of that visibility, if you don't know where your stuff is made, and still people don't want to share it. So it goes back to Chris and then our earlier speaker, I always forget his name. I'm sorry. Gene, thank you. I mean, he's sitting there going, there's this transparency fear. Why? I mean, as long as you're not sharing any IP, why? But I think you can say it's the same, and then there's still all these nuances that make it different. Like we have something when the 301 tariffs came in, it's like, oh my God, that's going to increase our prices. It's going to be like 40%. So what did we do? We moved it in, bring it in through China, substantial transformation, came in and we weren't hit with the tariff. But that's what we had to do. We had to have partners bring it in. So again, with the end in mind, that's 100%. Yeah, absolutely.
Chris, do you have any?
Can I make a remark?
Please.
Yes, well, I don't want to ignore the panelists. So basically, I think that this is a good question in terms of component level in or semi-finished good product or finished good product supply chain. So I think that's the COVID situation and also the war on Ukraine right now actually is a weakening. We no longer can know actually which product will become essential. Just like the Melbourne materials. Karen, I used to work at IBM and HP. So I was working at the factories. So I know all that. So, but I think that right now, before say, oh, this is commodity, we don't need it, outsource, this is outsource. But now we realize that even the basic ingredients could be critical. So therefore, that's why I've been pushing for is a regional, not just US, could be including Mexico and Canada, take advantage of the US-Mexico Canada agreement, the free trade agreement, to build a smaller scale, cannot be the entire scale, smaller scale ecosystem, such that just in case, because it's very difficult to predict which materials, which level of supply chain would be vulnerable. So for example, pharmaceutical products. Most people did not realize it's the basic ingredients, API, active pharmaceutical ingredients, most of them are made in India. And if there are a critical crisis, we will have a problem. The ingredients made in India, ship it to China to make a lot of drugs and ship it to the United States. So the supply chain could be quite complex. The issue could be the drug itself, could be the ingredient itself. So we can no longer try to make a very simple classification that, oh, this materials is non-critical. That's my whole point about we need to build the ecosystem.
I agree 100%. And to your point, we have to have some sort of, I hate to say regulation, but you got to force somebody. If it's not profitable, you hear people going, I don't want to do it.
So we look forward to having you back again in a decade to see if anything has
Hopefully
really changed in that time. And with that, I think we better wrap it up.
Thank you. Nice meeting you, Chris.
Thank you.
Thank you to all our panelists. And thank you, Chris. Chris is also faculty director of the Center for Global Management, which is partnering with us on this conference. And so before you hit the leave meeting, a couple more announcements. That probably looks silly with the mask hanging up there. A couple more announcements that coming up, we have our Orange County Economic Outlook. That's going to be at the end of April. And then in June, we are partnering with the Ziman Center for our annual Economic and Real Estate Outlook. In September, we're going to be looking at climate change and how climate change should be influencing our forecasts. And we do our forecasts a very short term, but as the years go on, climate change is going to influence the economy more and more. So we're going to be looking at that. And December, digital currency, which is now a hot topic. And how does that affect the macroeconomy? So we look forward to having all of you back again in these future conferences. We'll also be having some webinars. And for our virtual guests, we look forward to having you in person soon. So let me, my paper's all crumpled here, but I don't want to forget anybody because once again, we can't put on these programs without the generous support of our sponsors. And I want to recognize them once again, our principal sponsor, RSM, our platinum sponsors, the law firm of Allen Matkins, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. At the gold level, Avenue Insights and Analytics, Bank of California, California Bank and Trust, California Steel Industries, Venture Forward by GoDaddy, Pacific Western Bank, Robert Half, United Airlines, and Wells Fargo, the private bank. At the silver level, Hathaway Dinwiddie and the Union Bank, the private bank. And at the bronze level, Dub Value Creation HDR, and InstaWork. And our Bruin level sponsors are Gerber Kawasaki Wealth and Investment Management, the Port of Los Angeles, QSC, Rosenthal and Rosenthal, and Webcor, our media sponsor, the Los Angeles Business Journal, and of course, our academic sponsor, UCLA Extension. Many, many thanks to all of these organizations that make these kinds of programs possible. We are most appreciative. Thank you for coming today.